stock shortage on the modern ways. You always found the peak on a flat bank. My song is yours.
I hear the bells, I hear the wind, I hear a song in my heart again, and the tenderness moves all things like a poltergeist in the streets. It's a silly rush that I used to get, singing Billy or reading Vonnegut. I could teleport to the stars, kinda strange that I'm all alone, 'cause you really hold me down like that, 'cause you really know it's down like that, like the universe is singing a song. Ooh, ooh, ooh. Do you feel it when you write like that? Do you feel it 'cause you're down like that, like the universe is singing a song? Ooh.
You can take the throne, body flows like gold, beating hearts like clothes. Without you, time moves slow. Do you think that I could stay? 'Cause if I leave, then I complain. I know this feeling's not a crime. You said you feel it all the time. But if you had to go away again, I just don't see you enough. I wish I saw you enough. It's something in the way I feel your skin. I just don't see you enough. I wish I saw you enough. If you saw me every
Please take your seats. The program will begin in 5 minutes.
forcing, 'cause I don't wanna be much. I love the way that we touch. Do you like all of my friends? Yeah, I want your attention. Before you never mention that you got time instead. Is that too much for your brain? But if you had to go away again, I just don't see you enough. I wish I saw you enough. It's something in the way I feel your skin. I just don't see you enough. I wish I saw you enough. But if you had to go away again, I just don't see you enough. I wish I saw you enough. But if you had to go away again, I just don't see you enough. I wish
I'd run in circles. I thought you would too. Maybe in another life everything worked out alright, and things that made this harder passed us by. But there's no bad dream to wake up from. No, I got it bad when it's the morning and you're all that's on my mind. If I don't have you, at least I still have.
Please take your seats. The program is about to begin.
And if I don't have you, at least I still have me. I never thought twice, 'cause you were my number one. I put you first 'cause you were my only thought. No more riding on the train, no more smoking in the alley. Now my secrets only stay with me. Everybody knows I'm upset, they don't even have to ask it. They know I believed in us last week. And if I don't have you, at least I still have me. And if I don't have you, at least I still have me. There's no reason to speak badly. We just reached our end. I will see you in parts of me, in who I was back then. If I don't.
Private markets have become a defining feature of global finance.
I see a couple of people doing some dumb things.
AI is going to be so disruptive that it renders countless businesses obsolete. I sincerely believe there is no bubble in the AI space. We are in the midst of a rupture, not a transition.
We call him too late. He's too late. Trump, too late, pal. He's too late.
Please welcome to the stage Bloomberg's John Micklethwaite.
welcome to, music's still going, and welcome to Bloomberg Invest New York. This is the 9th edition, we always like journalistic metaphors, of Bloomberg Invest, which is our marquee gathering for leaders across investment and finance. Each year we convene the allocators of capital, the builders of companies, and the managers of risk to make sense of a world that never stands still. And if you want any more evidence of that, you only have to look at the past weekend and the US-Israel conflict with Iran, and that's a stark reminder of how assumptions can be rapidly turned upside down. Just look at what's happening to Brent crude this morning, and if it's not Iran, it's the trade tariffs, it's the broader reordering of geopolitics around the world, all the worries to do with debt. There's persistent uncertainty. So our questions are, where will the growth come from? How do you price risk? And where are the opportunities amid all this disruption? At Bloomberg, trying to answer those questions is, in a sense, our day job. That's what our 3,000, or more than that, journalists and analysts in more than 100 countries try to do on a daily basis. Our mission is to deliver accurate, fast information that you can make decisions on with confidence, we hope. And Bloomberg Invest is the sort of live extension of that mission. Today is about insight, candor, analysis. Thank you all for joining us. Let's begin.
Please welcome to the stage Bloomberg's Lisa Abramowitz.
Good morning. Welcome. It's so good to see you all. I'm going to hand it back to John. He has an incredible guest lined up, as we have many incredible guests. Next one will be Apollo's Marc Rowan. After that, I'll be speaking with Don Fitzpatrick. He's the CEO and Chief Investment Officer at Soros. We'll also be hearing from the Ares CEO, Michael Arougheti. Many more, including Minneapolis Fed President Neel Kashkari. From those of you in New York today and tuning into the live stream around the world, we are so glad that you're with us. Before we get started, I want to take a moment to acknowledge our sponsors. Title sponsor, Invesco, QQQ. Our knowledge sponsor, Marsh. Our supporting sponsors, Allspring Global Investments, Deutsche Bank Wealth Management, Harborview Equity Partners, Moody's, and Salesforce. For those of you in person today, please scan this QR code. This code will take you to a landing page where you can find our Wi-Fi information toward the top, plan your agenda, and join the community. If you want to know who is in the room today, to connect our scheduled meetings, you will click on that icon. It will prompt you to download our event app. This app will also allow you to receive the agenda and subscribe to any sessions relevant to you and receive push notifications. If you have any questions about the Attendee Hub, of course, we have the help desk. Help. We want to hear from you today. There's also a tab you can click submit questions, and you can potentially get your answers heard on the stage. You can find more information on our sponsors here. If you don't already subscribe to Bloomberg.com and all our global finance coverage, today is your lucky day because you can get a discounted subscription. If you are active on social media, use hashtag BloombergInvest in your posts, and you can follow along with our coverage at Bloomberg Live on all major platforms. Lastly, please silence your phones. Now, let's get to the real stuff, the program. And I'd love to first have a little bit of what our next guest has been up to over the past year. Take a watch.
The reward for good origination is people want to invest with us.
We miss secular change. Technology change is going to cause massive dislocation in the credit market.
Please welcome to the stage Marc Rowan, CEO at Apollo Global Management, for a conversation with Bloomberg's John Micklethwaite.
Marc, thank you for doing this.
Always a pleasure.
I was just saying outside that when I just looked back in 2010, you had around 70 billion in assets. Now, as we said, closing in on $1 trillion. Should we start with kind of current affairs? You've got the conflict in Iran. And I suppose we can talk about the geopolitics, but on the basic question about what it's doing to the markets and the economy, how do you look at that?
It's disruptive. I mean, we've had this, our refrain on this has been, if you look at the numbers, things are great.
Yeah.
Everyone has a job, the capital spending is off the charts and very conducive to future employment. Government policy is very accommodative, capital markets are wide open. That's normally 95% of what you need to worry about, but now, as we've been saying, it's only 70% of what you need to worry about. The other 30% is geopolitics, it's government borrowing, it's excesses in capital markets, and it's technological change. None of this is unexpected. It's just here.
How do you rate those? I mean, do you worry about the Iran thing, say, more than all the trade disruption?
Personally, not really.
Yeah.
I mean, we always have an overreaction to the confrontation of problems. But this is a problem that needed to be dealt with, and if it were dealt with in other years, it would have been more difficult. And so the notion that it's being dealt with today, in some ways, is reassuring, notwithstanding the current instability.
Just going through that list of things you had government borrowing. Is that something that worries you particularly at the moment?
It's not something to worry about, but it is something to watch. We have seen points in time when investors have called countries to account for their fiscal picture. We saw it most recently in the UK. The departure of Liz Truss. And we have pretty much every government in the West spending more money than they are bringing in, with no sign that they are letting up. And so there is nothing that says this will end soon. Japan did it for nearly 3 decades. And so it's just something to watch. Normally, that kind of borrowing is inflationary. Normally, the restriction of the free flow of goods is inflationary. Normally, the restriction of the free flow of labor is inflationary. But we just haven't seen it. Having said that, if you're a credit investor wearing your credit hat, you don't get paid other than your coupon and your principal.
Yeah.
You look at the surrounding facts and you say, this has been a good time for risk off.
Yesterday, Jamie Dimon talked about inflation being the skunk at the party. Is that the way that you look at it?
Not so much the skunk at the party, but let's face it, we've had very accommodative capital markets. Notwithstanding the backdrop that I've mentioned of things that can be inflationary, we've seen rates go down. We've actually seen curve steepening. To the extent we saw a tick up in inflation, that would probably handicap the Fed's ability to further push rates down.
We just go into credit, these big arguments, and it strikes me there's kind of 2 levels of it. The first question is, do we think that there is more kind of laxness in the overall credit markets? That's what people, Dimon talked about, Lloyd Blankfein talking. And then there's a particular question of private credit. But just to look at those two, first look at credit as a whole. How worried are you about that? I've seen you say that actually the numbers aren't too bad, but how do you look at it?
So I don't spend a lot of time worrying about it. Companies are in pretty good shape. Consumers are in pretty good shape. This is not just in the US. This is pretty much around the world. Ironically, right now, it's governments that are not in good shape.
Yes.
Having said that, we're at the end, potentially, of a very long accommodative cycle in credit. And in every cycle, you have people who move out on the risk curve, who ignore things that are obvious. And it all feels good while it's happening, and then it doesn't feel so good once it arrives. Well, some of those changes have arrived. I mean, lo and behold, we think that AI might impact software. Is that news? Did we just discover that 2 weeks ago? But apparently 2 weeks ago, we discovered that AI is going to impact software, and we've been in a massive risk-off mode. And so software stocks are down almost 70%. I remind people that software first lien is senior to high-yield bonds and is senior to equity. So if you're going to have a problem in software lending, you're going to have a problem in equity, you're going to have a problem in high yield, you're going to have a problem in bank lending and broadly syndicated and everywhere else. Because to your second point, credit is just credit. There are good underwriters of credit and there are bad underwriters of credit.
Just on that point about tech, is that as I read it from what you've said, you were nervous about software before 2 weeks ago. But on the other hand, in terms when it comes to kind of digital infrastructure, there you're still fairly, you're less cautious.
So I'd say I'm going to give you a more specific answer because it requires a more specific answer. In our private equity portfolio, which is not the subject of this, we have zero software.
Interesting.
In our credit book, across the totality of the firm, it's a fraction of assets. We run a broadly diversified credit book that is not concentrated in software. The problem with software is that it was 30% of the levered buyout market, therefore it was 30% of the levered lending market, and therefore it is just overrepresented and subject to attack. But we should not deny that change is coming. And change is not coming just in data centers and AI. As a world, we are building infrastructure, we're building energy, we're doing energy transmission, we're building next-gen manufacturing, we're ramping defense, and we're doing this thing called AI and data. We're essentially spending every dollar since the creation of FIRE, and we're doing it all at once.
Yes.
And whatever we're doing in the US, they want to do in Europe, and they're not as well prepared to it, and they're doing it in the Middle East, and they're doing it elsewhere around the world. We will see the largest need for capital ever. And that's what we've seen so far this year. And so now to your specific question, it's about underwriting. There are a number of very strong US tech companies who run diversified businesses, Amazon, Google, Microsoft, who are interested in seeing these centers built and are interested in not consolidating the debt on their balance sheet. And to the extent they are prepared to lend their credit, one can lend against those types of things and make sensible underwriting decisions. There are those who are more equity story oriented, where it's maybe not as sensible an underwrite, and good underwriters pick good credits and bad underwriters pick everyone.
You and I, though, have lived between us through a lot. I think we're almost identical ages, rather strangely. But we've lived through many iterations of kind of credit coming and credit going. So when you talk about these individual decisions, like, is it good to be in digital infrastructure at the moment or not, that matters. But so does the overall picture. And the one you just explained, where you said there's all this money going into energy, going into AI, going into all these different bits. Does the bill for that either end up with taxpayers, or does it end up with banks and credit institutions?
So, again, a longer answer than you probably want here, but the banking system is incredibly delevered and very diversified. I think it's in the best shape I've ever seen it in my 42 years of professional career. And then we get to the so-called public and private markets.
Yeah, that's
private and public are just variations of the theme. The vast majority of the private market is investment grade. There's a $40 trillion market, and 99% of the headlines are focused on a little slice of $1.5 trillion called levered lending. Levered lending is a below investment grade activity. If you trace the history of this, in 2008, levered lending was on bank balance sheets. Post-GFC, banks distributed this credit. On the one hand, you had the CLO market, which took credit off bank balance sheets, particularly less than investment grade credit, and distributed the risk to investment grade buyers on a senior basis and to below investment grade buyers, high yield buyers on a junior basis. Then credit was also distributed to private market BDCs. Banks again supported them, but at a very safe tranche, and investors, private investors, retail investors, institutional investors, came in to support private BDCs. And now we look at it and we say, well, credit is going through a cycle. Is that good or bad? And the answer is relative to what? And this is the point that people often miss. Credit is the formation of credit, particularly in these private BDCs, is a de-risking activity for the economy and for individuals. It's de-risking because it moved it off bank balance sheets and essentially democratized it throughout our economy. And it's de-risking for individuals because people are not funding their investments in these BDCs with their treasury portfolio. They're selling their equities. Last I looked, first lien debt is senior to equity. They are making an intelligent decision that they can earn equity-like returns without equity-like risk and take money off the table. That does not guarantee success. You can have If you own software stocks, you're really unhappy. If you own mostly software first lien, you're really unhappy. You're just less unhappy than if you own the equity. We can't legislate out of existence stupidity.
But the underlying system you're arguing is safer because it's allocated to individual companies and it's not leaking back into the fully leveraged part of banks.
And that's what, in some ways, we can say the post-regulatory reform of the GFC worked. It's doing exactly what it was supposed to have do. It has socialized this risk. It has given investors another thing to invest in, which is actually de-risking for them. And it has moved it out of the levered, government-guaranteed portion of our economy because we made a choice, and we've made a choice going back to the formation of Drexel. Below investment-grade companies have been a massive source of growth. Private companies have been a massive source of growth, 80% of jobs. How are they financed? Well, they weren't really financed. They were cast out from the marketplace. If we want them to be financed, there's only two places they can get financed. One is the banking system. The second is the investment marketplace. If you're concerned about what's happening, you don't want it in your banking system. You prefer it in your investment marketplace where people can price the risk.
So to the extent there are problems in private credit, you would argue it's a little bit more like the dot-com problems of years ago, where it's really an equity play rather than a debt one, so there isn't that gelignite of leverage going through things.
Almost every investor is not a levered investor in the private credit ecosystem, but we've also, we have this habit of throwing the baby out with the bathwater. All the press is focused on this levered lending portion of the market. As I sometimes remind my partners, as a deal shop, we don't get to be that big. Yeah. Because although we're doing something from an efficiency point of view, we use up a lot of social capital. On the other hand, the vast majority of the market is private investment grade, which is also called private credit and has almost nothing to do with what we're talking about today. So I think I try to be careful in using my language to make sure that we understand most of the capital going into private companies is actually going to finance this global industrial renaissance which is taking place around the world. A lesser amount of capital is going into the deal business, which is primarily being funded by investors or by institutions who are making a decision to sell their equity portfolio to invest in credit because they offer about the same rates of return. And by the way, we have 10 companies that are 40% of the S&P. We're not even a, quote, qualified market at this point. We're too concentrated.
There is this issue, though, isn't there? The private people, consumers are trying to get involved in this, and you pushed into kind of retail 401ks, things like that, which, they're investment grade. That's what they're looking at. Some people say that, Apollo was a buccaneering shop. It was all about being at the forefront. The more you get pushed back into these investment grade debt and stuff like that, or you might say expanding into it, do you worry that limits the kind of risk appetite of the kind of people you want to bring in?
I don't think so. I think what happened in our market, if you go back again to the history, going the 80s and the formation of Drexel created the high yield bond market. It basically provided capital to these companies. The banks responded with levered lending. All of the brain power in the financial marketplace left the investment grade market, and everyone wanted to do levered lending and high yield bonds because that's where the money was, that's where the excitement was. And it didn't come back into the market. The investment grade market is a drive-by market with very low compensation, with very low creativity. What we've done starting 17 years ago with the need to create investment grade for our captive insurance carrier, Athene, and for others in the insurance market, was to put creativity and intelligence back in the investment grade market. No one is bored. I can tell you that this is not now a question of they're no longer buccaneering, so they don't enjoy being there. The ability to be creative in the investment grade market is at a scale that's almost hard to imagine. So if you think last year we originated a little over $300 billion of new investments, mostly credit. 80% of that was investment grade. I assure you, no one is complaining about the lack of buccaneering.
But there's one good thing about what's happening out there, is you could argue that finance has moved into private markets, moved into non-bank. What's happening is consumers are now getting a chance to participate. But there is a kind of trade-off, isn't there? That the more this is giving them a chance to participate in these higher yielding areas, which you've pioneered. But some people will say there is a degree of risk in that, and at some point that could cause problems.
There's always a degree of risk.
Yeah.
So I come back and no investment offers you a free lunch. There is no free lunch. You can take equity risk, you can take credit risk, you can take duration risk, you can take all sorts of risks. The question is what's appropriate. But if you look around the world, every place that private assets have been added to public portfolios, you've gotten better outcomes. And if you go to the extreme and you take retirees, for instance, in 401k, an extra % compounded over the duration of how long you're going to be in there is a 50 to 100% better outcome by having better investments. And what are they invested in today? Well, they're invested in daily liquid index funds for 50 years. Is that risk-free? No. We have 10 companies that dominate the S&P. We've essentially, as I sometimes joke, we've levered the entirety of the retirement system of the US to NVIDIA. So far, that's been good. It's not always going to be good. Public is not safe or risky. Private is not safe or risky. They're both safe or risky. They're just differing degrees of liquidity.
I suppose it's this, is that traditionally this kind of slightly riskier on the face of it lending has been outsourced to professionals like you and to people who know what they're doing. The worry is that suddenly you're now getting, in Britain we call Aunt Agatha, coming into these markets. That's more worrying.
Look, we're going to have a correction, but it's no different than the correction that's happening in banking. If you look in banking, the dominant banking institutions of today were not as dominant pre-crisis. Those that sat out the subprime lending have arisen and become magnified in terms of their fortress balance sheet and market share because they were good managers of risk and good managers of underwriting. I believe the same thing is going to happen in investment markets. Investment markets, people made choices. If you wanted a higher dividend, you could take more risk, you could lend to smaller companies, you could do more PIK, you could invest in equity and preferred, not just first lien, and you could run with a lot of leverage. That felt really good on the way up. That's not going to feel so good on the way down. And there are companies, of which we are one, but not the only one, who went all first lien, who went almost all cash pay, who went large companies, who work with low leverage. I like where we sit, and Jamie Dimon said it, there's always going to be fraud, there's always going to be underwriting mistakes. But the question is who's a good risk manager and who's not a good risk manager. If 30% of your portfolio is in one industry, and that one industry is being impacted by technology, you have not been a good risk manager.
I think that I just looked at Blue Owl, I think it was 70% in different versions of tech. There is a parallel, though, isn't there? The way you described the banking industry, it has consolidated, particularly at the top. That would imply the industry you're in is going to consolidate as well, that you will end up with fewer people because, as you said, there is a reckoning coming. Some of those people will have to...
We have fewer people. I mean, you started. I mean, we were... The entirety of the companies that you see that are public today, everyone was $40 billion in 2008.
Yeah.
We're now close to $1 trillion, Blackstone more, KKR a little less. This is not good management, or not solely good management. This is a function of structural change in our marketplace. And that structural change is continuing, and the reward for good work is actually more work. In our case, it's managing more money. And I think that is where we're heading. I think this will be a shakeout. I don't think it is going to be short term. I think the 30% overhang of geopolitics, inflation, technological change is now here. It was foreseeable, not maybe exactly how it occurred, but it was foreseeable, it was predictable. And all you can do is have been a good underwriter, a good risk manager, have done a small number of stupid things. And by the way, we've lived in an environment of tight spread. If you were a good risk manager, you are going to make more money this year and next year if it continues than you ever have before because you've been risk off. And so that's always the bifurcation of minds. First, you want to play defense and make sure, in fact, you've done what you think you have done, which is manage good risk. And then you want to play offense.
Do you think, though, you're going to end up with mega mergers in this bit? I mean, that's what happened in banks at some point.
I don't think so, because I think that we are limited by two other factors. I think our business is will not in the long term be limited by capital raising. It will be limited by our capacity to find good investments and by culture. So unlike a public asset manager who can buy anything any day, we can only grow as fast as we can originate good risk. We actually create. And therefore, if we grow too fast, we start commoditizing our business because we're forced to take things we don't want. And so judging our industry should be judged by our capacity to originate good investments, not by our capacity to raise money. But the second piece of this, and they're directly related, is culture. We are, at the end of the day, an origination-driven organization. Whether our peers say this or not, they are origination-driven organizations. Often we're doing the first of everything. It's very hard to feed the first of everything into a model and get the right answer. We will be more efficient because it will not ignore us, technological change. But the ability to attract the best people, have them want to come to work, have them spend their whole careers at Apollo, is the primary job that I have.
On that, it strikes me, if you look at all the things we've talked about, you're lending money, you're trading private credit assets, we just saw the headline up there, you're building a kind of retail business. At some point, you begin to look very like a bank, with the one exception that you're not taking deposits. Is that really what it's coming down to in the end?
Not really. I mean, what you look at is a bank works with a government guarantee. They take deposits.
Yes,
they do maturity transformation, and they primarily make money from the capacity of their own balance sheet. We do 2 or 3 different things. One is we don't take deposits. We don't have a government guarantee, but we originated investments and we distribute them. And for a small portion of the investments, generally, as I say sometimes, 25% of everything and 100% of nothing, we keep on our balance sheet to match with our retirement obligations.
Banks do a lot of those sort of things. They will originate loans and then distribute them. It's not that different.
I'll make the comparison slightly differently for you. If you're a public asset manager, you come in every day and you make a decision to buy something, and then you distribute it amongst the accounts that you manage, and then you go home. We kind of do the same thing, except we don't get to buy something in the public market. We have to go find it in the private market. We structure it, we originate it, we distribute it amongst the accounts that we manage, and then we go home. And so everyone in the financial market, if you're not solely a trader, you're an investor. That's what we are at the end of the day. And in the broadest sense, if you think about the drivers of our business today, there are 2 drivers of our business. One, global retirement crisis. Everywhere in the world, we are short retirement income. Guaranteed lifetime income, retirement income, is a fixed income obligation. On the one hand, we need to produce retirement income. On the other hand, we have this global industrial renaissance primarily taking place amongst investment-grade companies, and we find ourselves in the middle. We originate risk, we put some of it on our insurance company balance sheet, and we distribute the rest to investors and source it for them without maturity transformation, without government guarantees. And I believe we are playing a more important and a different role than most people perceive. And it's not just Apollo. This is the private market firms who have gotten to be sized. You don't get to be sizable in the deal business. The deal business can only get so big. You have to serve some fundamental public good, otherwise you don't get to be big.
You talked about culture, and as you know, Apollo's been drawn into the Epstein thing because your fellow founder, Leon Black, who left in 2021, was part of it. Apollo's done an investigation, said everything was to do with him. And I'm sure this eats up a lot of your time, but just as a sort of general question for you, well, a strange one. If you look back at that whole period, regardless of individual meetings and things, when you look back, now looking at it, what would you have done differently, other than perhaps not having had Leon as a partner?
Look, Leon made his own decisions, and I will not do that. But the answer is nothing. This is, whether through good judgment or good fortune, this is not someone I built a personal or business relationship with. It's not someone that Apollo did business with. If a relationship is one meeting over 20 years and a couple of unreturned emails, then that's a relationship. But other than he was Leon's tax advisor, we ran a partnership, not a company back then. Leon's tax position was relevant to my tax position. Other than that, I'm very sorry, and I didn't see what Jeff was doing. Me, I didn't like him for my own reasons. He wasted my time.
But now it does occupy time and questions as well.
Even from the grave, he's wasting my time.
Marc, Rowan, thank you very, very much for talking to us.
Thank you. Thank you for having me.
Thank you.
Please welcome to the stage Dawn Fitzpatrick, CEO and Chief Investment Officer at Soros Fund Management, for a conversation with Bloomberg's Lisa Abramowitz.
Well, following that wonderful conversation, you get another one. One of my favorite people, one of the best investors I can imagine, Dawn Fitzpatrick. She is CEO and CIO of Soros Fund Management, formerly 25 years at UBS. Very curious, before we start, we were planning to talk about all sorts of things that had nothing to do with oil. Yet here we are. I wanted to start with that. How much the past 3 days have upended things or been revealing in terms of how markets have responded to this latest shock?
Yeah, so I mean, you can see the price action today where markets are definitely under stress. And when you think about coming into kind of this week, at a high level, markets looked kind of benign. If you looked at index returns, they were flat to up. But below the surface, we were seeing a pretty violent rotation. Part of what you just heard Marc talk about. So markets definitely felt a little fragile. Then we come into yesterday, and I was surprised that the market rallied back to flat. But I think the realization that investors are coming to now is this is not going to be a couple-day event. This is going to be really, really hard. And I just think market participants are dealing with an enormous amount of uncertainty. You have, obviously, the AI disruption. You have, geopolitical risks. And I just think that, under the surface, there's a lot of fatigue from all of that.
We're going to get into the under the surface in terms of AI disruptions and things of that nature, but I want to start with what has been priced in so far and what hasn't in terms of how resilient the U.S. and, frankly, the global economy are to some sort of, call it stagflationary shock, a big increase in energy prices.
Yeah, well, you see, by the way, around the globe, you're starting to see rate cuts priced out of the market. So Friday, through December, there was roughly in the U.S. about 60 basis points. That's down now to about 40 basis points. And you obviously have seen kind of the 10-year U.S. Treasuries move 15 basis points higher. And from an economic perspective, you're basically seeing a fairly dramatic tightening of capital conditions. And I think that really is kind of worrisome on a lot of different levels.
Does it make sense to you, though, that actually that would be the response from monetary policymakers to raise rates or not to cut rates in the face of higher oil prices?
Yeah, so I think, and you've heard the U.S. Federal Reserve talk about this a little. They like to look through temporary increases in oil. And again, when you look at the impact of oil on the U.S. consumer, it's only about 5% of their spend. But I do think there's knock-on impacts. So I still think, actually, I would bet the Fed cuts 2 times. And I think they will look through this as long as it's contained to under, say, 3 months. But we'll see. I actually think they should also look through, in part, some of the AI boom, because whether rates are 50 basis points higher or 50 basis points lower, it's not going to impact the amount of CapEx that's going on there. And then under the surface, as I mentioned, financial conditions are tightening. I think the lower-end consumer is struggling a bit, while overall consumer feels okay. And I think that's a hard dynamic to deal with.
What's fascinating is normally when people think, oh, there are going to be rate cuts, that's yay for risk assets, risk on. The scenario you're pointing is cutting rates for the wrong reason, which is actual weakness, true stress that you're seeing get into the market, whether it's low-income consumer or whether it's these pockets of financial stress. Is that correct? Do you think that the rate cuts won't help add to risk appetite or could potentially be indicative of something more of a problem?
So a couple things on that. First of all, at a high level, I actually think the U.S. economy and the global economy is going to the recent headlines notwithstanding, is going to grow higher than expectations. I do think inflation is moderating. And again, I think rates where they are modestly restrictive. So I don't think it's necessarily like a rate cut into a disaster. I think the Fed has room to lower rates. And in the context of everything going on, I think it would be smart of them to do.
So you don't think inflation is the skunk at the party?
Pardon?
You don't think that inflation is the skunk at the party, as Jamie Dimon would say?
Yeah, I think it's going to continue to trend lower. And I think things like AI, while right now I don't think it's having any effect on inflation, I think ultimately it will.
Meanwhile, the market has been tumultuous under the surface for a while, and we've talked about, you heard Marc talk extensively about the software concerns and how much that's really impacting private credit in particular. Where are we in that washout? Do you have a sense of how far along in terms of recognizing who the winners and losers are going to be in the software shakeout?
Yeah, and I think Marc spoke to it. When it comes to private credit, we saw the Blackstone headlines overnight. I think that's going to take a while to work its way through the system. I think we're going to continue to see elevated redemptions. I think some of these structures are going to come under pressure. So in publicly traded BDCs, they're trading right now on average at about 23% discount. The private BDCs and the interval funds have to return capital at NAV. And the rotation is going to be redeem those private BDCs and interval funds and transition to the public BDCs. You'll get a higher yield even if the NAV discount doesn't close. So I think you're going to see that. And I think ultimately what happens there is it's going to put pressure for there to actually be secondary sales in private credit. And the other thing with private credit is, not all funds are created equal. Some funds have disproportionate amount of exposure to the software sector. And again, I think within the software sector, this is a structural re-rating that is deserved. So I think really doing your homework on where kind of what kind of exposures the underlying has is going to be really important. I also think investors, big endowments, high net worth are over allocated to private assets. Their private equity isn't cash flowing, and now they're going to have a similar issue in private credit. So I think it's going to be a painful 18 to 24 months.
Let's get to private equity in just a second and how it's not cash flowing and what that means in terms of just investor appetite for the asset class. How much pain is there going to be? I mean, where is it going to be expressed in the software shakeout? You were talking about BDCs and the shares. People have pointed to retail funds, and you said Blackstone, the idea of lifting redemptions to, I believe, 7.5% of the fund, saying, look, we can meet these redemptions. I mean, what's the model for how you view this proceeding?
Yeah, so first of all, I think what Blackstone did was broadly smart. I think when you look at these alternative asset managers, I think returning capital in a way that they promise to investors is going to be long-term. Short-term, it will hurt their fees. Long-term, I think it will massively aid their businesses. And I think there's going to be a differentiation between alternative asset managers who do that well and ones who don't. So I think that's going to be really, really important, keeping your promises to end investors. And I don't think memories are going to be short for managers who don't do that. By the way, if you're a BDC trading at a 23% discount, you should be selling loans and buying back shares. And the only reason you wouldn't be doing that is to maximize your fees, which is really hard to justify. So I think it's going to be really interesting to see how much people stick to kind of fiduciary responsibilities. And I do think it's going to be a culling of the alternative asset managers.
As an institutional investor, do you want to stay away from private asset managers or private credit funds in particular that try to cater to retail funds?
No, to be clear, we're kind of dipping our toe and buying some of these public BDCs, the ones where we like the underlying loan portfolios. So it's kind of the opposite. We like to provide liquidity when liquidity premiums are blowing out. And I would argue that this is going to be one of those moments in time. Same thing on the secondary sales. There's going to be great opportunities there. And we're definitely going to be a buyer. We are in a good liquidity position, and kind of looking forward to a little bit of carnage in private markets.
So I hear this all the time. When things start selling off or dislocating, people say, oh, I can't wait for the dislocation. I'm looking forward to buy. And then when things start getting pretty heady, people start saying this time might be different. There's going to be contagion, and I don't know who's going to be potentially exposed. What are the nodes of contagion where you could see this become a bit more systemic and cause concern that goes beyond just the knowable risk?
So there's $300 billion of back leverage on private credit funds through banks. And generally, that leverage, while loan to value is modest, it is mostly mark-to-market, and those loans generally have not had a lot of mark-to-market volatility. And I think there's going to be regulatory pressure to start remarking those loans. And once they do that, those private credit funds are going to have to come up with cash to meet those margin calls. In most cases, they have some excess cash, but I think those cash reserves are going to run low quickly. So if you start seeing pain or scrutiny on the banks on that lending side, I think that could be a harbinger of worse things to come.
To what extent does it have a risk for the financial sector more broadly?
So, software employment as a percent of the U.S. economy is less than 1%. I think where it plays into the broader economy, it is where I started. It's general financial conditions, and the cost of borrowing is going to go higher. I do think the offset to that is bank regulation is easing, so banks have more ability to loan into this. And I think Treasury Secretary Bessent made this comment the other day. I don't think Washington really minds that shift from private credit lending incrementally to the banks. So I think that's a partial outlet valve.
One aspect of this is the pain. What about the gain? I mean, how are you seeing potential opportunities, not only as we see the shakeout in BDC shares, for example, but in the AI transition where it's not just going to be losers, but also will be winners?
Yeah, I mean, so even in the public software sector, there's some names that we think ultimately will be winners. The other thing on AI is you see companies who are using operating leverage to spend a lot of money on technology right now. And by the way, JP Morgan initially got criticized for this. I think ultimately what you're going to see is, JP, the Goldmans of the world, the Walmarts of the world are creating a moat relative to their competitors. They're going to press an advantage that will become very, very apparent in a year or two. And I think AI is going to play to the people who are bigger and can make those investments structurally.
How do you want to get exposed to that, right? I mean, this is sort of a question the audience just asked, which is just can you talk a little bit about your asset allocation, but in terms of public, in terms of private, in terms of illiquid, in terms of macro, I mean, how are you sort of arranging this?
So relative to other endowments, we leaned incrementally out of private equity back in like 21, 22 to give her and replace that beta with public markets. Again, we might use this moment in time if things get sloppy enough to change that mix. I think in public markets, you're seeing a lot of dispersion. The rotation we talked about from kind of old world real economy that's done really well this year and away from asset light. Under the surface, there are great ways to pick winners and losers at the company level, and you're getting paid for that. So we think being in public markets, having kind of an alpha-oriented portfolio is really important. I think diversification at kind of the asset level also, even though treasuries are going the wrong way now, I do ultimately think that treasuries, will be a safe haven, and having, a reasonable allocation to government bonds is important. On the credit side, we've leaned out of a lot of credit recently, but it's really just to create dry powder for the opportunities that we think is coming.
You use the word diversification, and a lot of people have used that to mean a lot of different things over the past couple of years. In particular, whether it's not diversifying in asset classes, but diversifying in regions. And people are saying they've been going away from the U.S. and going into more underpriced markets. I'm just wondering if you think that trade's done, and we're seeing sort of the shakeout of it right now when it's tested by the potential for an oil shock.
I don't think it's done. I think what happened is asset allocators kind of got lazy over time, and coming into last year ended up way over allocated to the U.S. dollar and U.S. assets, and they're just trying to right those allocations. I think the initial move was pretty aggressive because they realized how offsides they were. I think you're going to see a continuation of that, but I think it's going to be more moderated and modest in terms of the impact. But again, I invariably think people got overexposed to the dollar and are just trying to get back on sides. But I don't think it's necessarily repudiation of the U.S.
Well, and I want to finish up on something that you kept saying, which is that private equity just isn't cash flowing. I love that concept, but it's not giving people the capital to reinvest and redeploy in the same kind of way and to reallocate to private equity. Where is PE in just sort of its cycle, given the fact that we haven't seen exits, we haven't seen IPOs, we haven't seen the kind of monetization of a lot of these investments?
Yeah, so I think there was a lot of hope coming into 2026 that it would be the year when PE starts to cash flow in a really meaningful way. What you're seeing is the IPO market is open, but it's only open for really high quality companies. We had $14 billion in secondary and primary sales last night, but they were utilities and insurance companies. And the other interesting thing about private equity is historically when private equity monetized an asset, you'd get like a 20% bump. Last quarter, monetizations were flat to down and I think that's a little bit giving up the ghost. On the plus side, 2026, you are going to see some mega IPOs. Unfortunately, these aren't necessarily companies held by private equity. But, rumor is you'll see OpenAI, Anthropic, SpaceX all go public. By the way, to put that in context, any one of them alone would be the largest IPO ever. In aggregate, if you get 10% float, it's about $250 billion of IPO proceeds. Which is more than the U.S. had in aggregate since 2022. I think that's good in a lot of ways in that it will clean up those cap structures. It gives them access to capital markets in terms of heavy spend. But that money is going to have to come from somewhere, and that's why you see like a really hard fought to get included in the indexes, which again will create natural buyers for those companies. But there's another side to that. It will mean people have to sell the other names currently in the index. And if you look at historical data, when you get a really big pop in IPOs, generally 6 months forward, the market re-rates on a multiple basis lower.
So we could expect that possibly going forward. Unfortunately, we're out of time. I could talk to you all day. That's Dawn Fitzpatrick of Soros Fund Management. Thank you so much. That was wonderful. That was awesome.
Please welcome to the stage Peter Fung, Managing Director and Chief Operating Officer at Harborview Equity Partners.
So good morning, everyone. Just a quick introduction on Harborview. We're a multi-strategy asset manager focused on entertainment, IP, and global cultural assets at scale. Our portfolio consists of iconic IP that defines generations, including songs from Fleetwood Mac to Bruno Mars and other timeless hits. I'm going to spend a couple minutes talking about what it means to redefine, or at Harborview, what it means for us in terms of redefining what it means to invest in culture. But to do so, just to give some context, historically investing in cultural assets like music has predominantly relied on gut, instinct, intuition. As a result, many people believe that investing in cultural assets is driven more by art than science. And frankly, that was historically true in an era historically driven by CD and vinyl sales. Episodic revenue with no tail, limited reporting, and limited visibility. But streaming fundamentally changed the asset class. All of a sudden, you had all these continuous signals where you didn't have to wait for durability. You can measure it. And no different than any other asset, you can structure asset safety through traditional risk management principles, not just based off of good ears and nostalgia. And that's what we at Harborview are doing. We're bridging the gap between analog philosophies and modern asset-based finance. One thing that is worth highlighting here is that unlike other traditional credit products, music is a little bit different, where your upside may be capped at a fixed spread. Music operates a bit differently in that you have equity-like exposure to global streaming adoption, as well as the improvement in monetization mediums such as Roblox, TikTok, and other forms. But similarly, with the right asset selection and the right risk management principles, you have the same defensive yield and characteristics as other credit products. And the other thing that's worth understanding is that with music royalties, what comes with that is truly uncorrelated yield to the economy. Because when you actually acquire music IP, what you're effectively getting is not just what you're getting is a perpetual stream of cash flow, but also the underlying copyright. And that is a massive moat. Why? Because people don't stop listening to their favorite songs in times of economic uncertainty. And venues don't stop playing it as a result. So for us, what we've done is effectively, once again, bridge the analog philosophies of the past to the current. And how we did that was we built our own operating system that we refer to as HITS. It's effectively our tool to apply credit style underwriting to culture. It allows us to measure rather than guess what will be relevant in the future. So the one thing I'd like to reinforce for the crowd is what we're trying to do at Harborview is effectively, in terms of analogy, think of it as Moneyball for IP. We're measuring what others disregard, and we're moving at the own pace of our questions. Think of it as the following. The following is what we truly believe that we own is the information advantage. The information advantage that allows us to see from cash flow to creative spark to enduring IP. And what we're ultimately doing is building a portfolio of enduring IP that stands the test of time. Thank you.
private markets companies are to this, AI revolution that we're doing.
Arougheti, co-founder and CEO at Ares Management Corporation, for a conversation with Bloomberg's Danny Berger.
Thank you, everyone, for joining this conversation. I'm very thrilled to have him. Mike, thank you for sitting down with me today. What a time to be having this conversation. I mean, private credit is dominating the headlines, and if it's not that, it's other forms of volatility, be it concern about disruption of AI. And now the latest one we have to grapple with is the prospect of war and geopolitical uncertainty. Has that changed any of your assumptions for how 2026 plays out?
As surprising as this may sound, not really. And the reason being, as a private markets manager, we're thinking in 5, 10, 15-year increments, and you and I have had this conversation before. It's actually an interesting place to live as a publicly traded company that can experience the day-to-day volatility in markets and has to react, at least emotionally, to the daily headlines. But when we're making investments behind secular themes like realigned supply chains globally, the reindustrialization of the U.S. economy, digital infrastructure, and digitization, these are not things that get knocked off track by the things that we tend to talk about day to day. So inevitably, the world that we're living in may change geopolitically. We may see realignment of alliances. Energy prices has a big impact. We may see inflation come back in. So that's going to have an impact on certain things that we own, and we will react. But one of the nice things about being a long-term investor in the private markets is we don't really have to say, okay, the playbook that we had put in place for ourselves is now fundamentally different.
Have you started to think at all, again, early days, but of resurgence of inflation? If the Fed isn't able to cut as much as we assumed, how would that change things for you?
Well, it's interesting because part of this private credit story, as an example, and I saw it on the walk-up, the way that most large private credit managers are set up is that we're kind of hedged against outcomes. So if software disrupts a sector of our portfolio, then our digital infrastructure and data center development business benefits. If software disrupts the portfolio, then our renewable energy business benefits. So when we think about inflation, what's interesting, the private credit narrative is also around base rates coming down. So there was this anxiety that crept into the market that as base rates were coming down, the return available in private credit would somehow become less attractive. If we find ourselves in an environment where we still have inflation and rates are elevated, that's actually theoretically good for total returns in private credit. So I think you have to start thinking about both sides of every coin, and most of the things that we tend to talk about on a day-to-day basis have a risk and an opportunity associated with them. And when you look at a broad-based manager like Ares, we tend to be on either side, and so we tend not to get that worked up about any.
Just hearing you talk about that, though, let's take the software AI example. Not every platform has the size and scale to balance out a software exposure with AI infrastructure. So these pains we're seeing, if you can benefit by being diversified, what happens if you aren't? Is there a shakeout to come in this industry?
I think investing 101, and Marc, Rowan just talked about it too, diversification is a big way to mitigate risk. It's also a way to dampen return if you focus too much on diversification. So we're constantly trying to find that right balance of making sure that we can capitalize on volatility. And one of the ways you do that is you understand deeply what you own, so that when the markets get dislocated or disrupted, you can push in and play offense. Inevitably, if you are concentrated, whether it's AI or we saw it in the energy shakeout 5, 6 years ago, there are going to be winners and losers. Generally speaking, those that are more diversified will survive, consolidate, and probably grow disproportionately.
We've already started to see some consolidation. I have to say, I feel like you and I have been talking about consolidation for years. Does it feel at all that it's reaching a head at this moment, that you really are starting to see some funds that are limping along and their only odds of survival are to become bigger and join a larger platform?
So we've been talking about consolidation for over a decade, and back to secular themes driving the growth in private markets and capital formation is consolidation. So unlike investing in the public markets, size is not the enemy of performance in the private markets. It's quite the opposite, because the larger you get, the more resources you have, the more you can invest in local origination, product development, large balance sheet. The more relevant you are to customers, the more relevant you are to global investors. So size is not something that we necessarily pursue as an end goal, but what we're all experiencing is that the larger we get, the better our performance is. Consolidation is not about limping along and getting subsumed. There's been some of that, right? We acquired ACAS and Allied and other public companies coming out of the GFC, but it's more the high quality monolines. So to your earlier question about lack of concentration, if you're a infra-only equity manager, or you're a single geography private equity manager, but you have a 25-year institutional track record and a legacy that you want to sustain, you will try to get consolidated from a position of strength, not a position of weakness. That being said, if we continue to see the type of volatility that we're seeing now, I do think that you'll see, some of these weaker players get consolidated out.
What does that look like if you are not specialized, but you're still one of these kind of middle-sized players? Are they going to see a real squeeze right now?
I think so. The global LPs are looking to allocate more dollars with fewer managers. And they want to do that because they want better economics, they want better access, they want better information and analytics, and I think they're also seeing that scale drives performance. And so as this consolidation happens, you're going to see the large get larger. You're going to see niche, real alpha generative managers continue to thrive, and then I think everyone in the middle is going to have to really prove that they can generate alpha, or they're going to get squeezed.
By the way, just to point out, because I don't think you can do it, or perhaps you're too humble to do it, last year you raised two of the largest ever funds, $30 billion and $35 billion in direct lending. And that feels like evidence of its very self, of the big getting bigger. So in a winner-take-all environment, or winner-take-most, 5 years from now, what is going to be the size of this industry in terms of number of platforms? Are we talking there's just 5 to 10 players? Is there more than that?
Yeah, I don't know. If you look, you have to look for an analog, and generally speaking, in financial services, players can max out at a 25% market share, and then you get diversification below that. So you can look at the banking industry where you have 6 or 7 large platforms. You can look at the insurance industry, and you can see that consolidation too. So I don't know if it's 5 or 10, but it's going to be a handful. To your point, though, on the capital formation, last year we raised about $115 billion, which sounds like a big number in the grand scheme of the markets and where we were 5 or 10 years ago. We actually put $145 billion to work. So as you're consolidating capital, you're also consolidating the ability to deploy that capital. And so that's part of what compounds this market leadership.
So how are you thinking about the Ares platform specifically as this trend unfolds, as it makes sense to have scale? Are you looking at growing not just organically but inorganically as well?
Yeah, our history of growth has been a healthy combination of organic and inorganic. About 75 to 80% of our growth historically has been organic, 20 to 25 inorganic. We tend to lean into an acquisition when we see a market that is going through some kind of transformational change or secular shift, where we think we have a right to participate and win, but we just don't have enough scale, or we're missing a key piece of information edge, or we don't have the right distribution. And so when you look at where we're acquiring, other than small tuck-ins that we'll do, it's going to be in big transforming markets like data center development or wealth distribution. Most of those boxes, frankly, are checked for us right now. And so most of the growth, I think, for the foreseeable future will be organic, leveraging the competitive advantages that we have on the distribution and investment side to grow within the business. But there are still a couple of things that I think would make sense for us.
Well, part of the thing, and actually let me get to that first. What would be those couple of things that make sense for you?
Yeah, we've been public about this. I think getting larger in private equity could make sense for us. We've been in the private equity business for as long as we've we've been in existence, but it just hasn't kept pace with the rest of the business in terms of real estate, infra, and credit. I think there's an argument that someone of our size and global reach should be larger generally in private equity.
I mean, there's a lot of players out there, and probably a lot of smaller players who would love to be part of the Ares platform. How do you evaluate that when you look for potential managers to buy? What are the characteristics of a good private equity bolt-on to Ares?
I just realized now my phone is going to be ringing all day from every investment
Everyone's going to be pitching
banker
you, for sure.
Look, it's all about track record, and this is something that people don't talk about enough, and so I'm going to answer your question a little bit differently, because when you get into a world that we're living in now where you're seeing outflows and volatility in stock prices, it all comes down to fundamental performance, and top quartile, top decile performers that can demonstrate that they can deliver outsized return in any environment grow. So we have a simple saying at Ares that assets follow performance. If you perform, you grow, and if you do well for your investors, they do well by you. So particularly in markets like private equity, and frankly, when you get into the equity part of the capital structure, even in real assets, performance is kind of the top criteria. And then I think it's about, can you really generate alpha? And this is going to be the big shakeout in PE. We're coming off of a decade where you had a lot of beta players who, because of the rate environment that we were in and because of the nature of supply demand in the market, were generating what looked to be best-in-class returns. And now that arbitrage is gone, and you really have to, you're going to get an opportunity to see which private equity managers can really make companies better and transform them. And I think those are the ones that you would want to own.
Do you think they're far and few between?
I think there are. I think if you were to actually look at the math, and this is something that we do in our secondaries business, when you look at the number of managers globally who can really generate alpha consistently, there just aren't that many. It's actually a very unique skill set. So I think people are going to be paying a lot more attention to that over time.
Can I ask, because a lot of times people use the corollary of hedge funds, a medallion fund that can only grow so big because if you're too big, you eat away at alpha, that scale matters in this. And people love to point to the private capital industry, be it credit or equity, and say they're growing really rapidly. They're going into retail. That means that deal quality is being sacrificed in order to put assets to work. Is there a type of environment evolving right now where alpha is being eaten away at because the industry is growing too rapidly?
I don't think so. I mean, I'm sure that there are players who haven't built the origination or portfolio management capacity to drive alpha through this type of market. But I just look at our track record over 25 years in the private credit business, and it's been a 12 to 13% plus asset level return through everything that's been thrown at us, with loss rates near zero. And so I think that's something that people will continue to have appetite for. But this is the thing that's tough. When you're investing for the long term, we're not going to know. And what we always try to say to our investors, both in the private market and public, is focus on performance. I know that historical track record is never a predictor of future return, but there are good investors and bad investors. And it's very hard to take a bad investor and suddenly make them a good investor just because they can raise money in multiple channels. So there's going to be a little bit of a dispersion in return, but that's okay. There's dispersion of return in the mutual fund business, right?
It also, though, feels that, yes, track record, but when it comes to more of the retail type funds, it feels like some of the selling, or at least redemptions, has been indiscriminate. And you can talk about what you're seeing on your platform as well. I know you've seen net inflows, not net redemptions. But you're seeing redemptions on platforms like Blue Owl or BCred when it comes to Blackstone that don't necessarily have bad performance. You can see where they're marking. So what is going on that you are seeing some retail pulling back from some platforms despite performance which hasn't been as bad as the headlines would suggest?
It's a confluence of things. Number one, and it goes back to diversification. So if you are going to have a playbook to win consistently through cycles, you have to be diversified in your asset mix. You have to be diversified in the markets that you participate in from an investment standpoint, geography and other. And you have to be diversified in your distribution. And I think one of the challenges, and we experienced this, when we first started our private credit business, it was dominated by our traded BDC, ARCC. And we managed that, we think, fairly well through the GFC, acquired a number of troubled managers, and then realized that as wonderful of a structure the publicly traded BDC was, it was inherently pro-cyclical because we just couldn't raise the capital that we needed when the markets were dislocated, and we were getting capital that was coming into the platform when the markets were healthy. By the way, banks are pro-cyclical. There's a lot of pro-cyclical structures. So the light bulb moment for us was we needed to diversify our capital base, and so we moved quickly to build the institutional fund complex, those $30, $35 billion funds that you were talking about, so that we would always have the dry powder and the investment capacity to navigate changing market. And then once we felt that we had that well in hand, we said, let's go into the wealth business. But if you are over-indexed to wealth, you're going to be inherently pro-cyclical, and that's part of what's happening now. Now, the challenge is, I think these products are still in their infancy, even though the market is large, and I think they're misunderstood, right? These were not meant to be liquid funds. They were meant to be illiquid funds with an option for structured liquidity, and that liquidity is supposed to come orderly so that the folks that want their capital back and the folks that are putting money to work are not disrupting the fundamentals. So as of now, that's how the market's working, right? So you are going to see inflows, at least in our case, exceeding outflows. You're going to see in certain cases, you know, that not happening, but the structure's working and that liquidity needs are being met. The other thing I would highlight, this is not a case of 100% of investors in a given fund wanting 5% of their money back. And I always just try to get people to focus on kind of the facts and not the noise.
Right.
When there's a 5% redemption queue, that could mean there are 3% of the investors representing 5% of the capital that want their money back. For some reason, maybe they're getting hit in another part of their portfolio and they need liquidity, right? It may not be a reflection of their view of that specific fund. But what that tells you is there's 97% of the investors in that vehicle that want to be in that product, and then there are new investors coming in. So this is something you and I talk about when we're thinking about how we tell the story of what's happening in the market. This is not an unwind or a lack of appetite for private credit. We are still seeing significant appetite across the spectrum of our 8 wealth products. There are corners of the market that are looking for liquidity, but there are still people that are allocating aggressively into it. And I think that's just, we're going to have to find where that equilibrium is. Different managers will have different experience, right, based on track record and size and brand and all of those things, but that's not necessarily a bad thing.
Do you think the industry will shrink as a result of all of this?
I don't. No, I don't. I look at our own experience as an analog. We have 8 semi-liquid products. They kind of ebb and flow in terms of investor demand. You can have significant retail demand for real estate. That gives way to demand for private credit and infra. But when you look at the opportunity for individual investors to get access to these assets, if you were to talk to the large wealth platforms, they're still seeing, you know, a significant amount of demand for these products, and they will tell you from a model portfolio standpoint, they're massively underallocated.
Right. So if performance is healthy, I wonder what you make of this. This got a lot of attention last week. UBS saying that there could be 15% default rates in private credit. Does that sound right to you?
It sounds absolutely wrong, and when I saw it, I thought it was actually irresponsible.
Talk more about that.
And this is part of the problem when you have someone who's actually never been in a segment of the market making commentaries about what default experience can be. That's actually irresponsible. If you were to look at private credit, default rates have always lagged default rates in loans and bonds. So that's just something that people should take a look at. Default rates and loss rates have always lagged loss performance in bank C&I portfolios. So people should take a look at that. And if you look at the GFC, you would see that private credit portfolios as an industry were probably down somewhere 8 to 10% for 1 year default rate, and then rehabilitated. So if you're talking about 15% default rates in private credit, which again I think is just not possible, but if you're there, everything else in your portfolio, I assure you, is going to be completely torched. So we could talk about private credit specifically, but again, to decontextualize it from what that would be telling you about what's happening in the broader investment markets, I think is problematic.
What do you think the world is getting wrong then? Because you can't just blame the media in this case, which I know, I'm not saying you do, some of your peers love to, but if, you know, an institution like UBS is getting this wrong, what do you make of that?
Well, like UBS as an example just lost a significant amount of money in a loan called MFS, and that particular analyst didn't actually write a story about that. So I thought that was interesting. I don't think they're getting anything wrong, to be honest with you, and this is part of the signal through the noise, is the markets right now are so conditioned to react to any headline. And the reason they are, structurally, the public markets are fundamentally different than they were. You've got massive concentration of market share. You've got a significant amount of algorithmic trading that happens in the market. And most public equity investors are now focused more on momentum and positioning than they are in their ability to actually carry out a fundamental investment thesis. So I don't know that they're getting anything wrong. I think it's more of a commentary on just how investing in public markets works now, because you have to be out ahead of whatever that headline is, because that headline is going to drive momentum, and if you're not positioned appropriately, it hurts. So I think based on the velocity of the news cycle and the structure of the market, all you're seeing is investment behaviors changing, where we're not actually able to talk about long-term fundamental business plans.
Right.
And we're focused on short-term noise. And that's okay, but it's also one of the reasons why I sit here so confidently being in the private markets, because we know we have a business plan for every asset that we own. We're going to execute on it, and ultimately we get judged over 5, 10, 15-year increments as to whether or not we improve the value of those assets over time. And there's going to be volatility, to your first question. That's going to change the way that the business plan gets executed, but the outcome should hopefully still be the same given all the flexibilities we have to drive value.
Right.
And it's unfortunate because I think the public markets have moved away from that. Active investing in public equities is really difficult.
Yeah.
And it's difficult because of some of this, just, you know, the way that information is getting consumed.
By the way, as you know, we've talked about how you've expanded the Ares platform. One area that you've also very expanded into, and I know we only have about a minute left, but I'd be remiss if I didn't ask about your sports platform and the growth there, be it you know, investing in itself or offering to wealth investors. Why go all in on sports?
Well, we went all in on sports, first of all, because it's fun.
As good as reason as any.
It is a fascinating opportunity for us to participate in the development of a market that up until 5 years ago wasn't available to institutional or individual investors. So we want to be at the front end of innovation in financial markets, and we identified sports as an opportunity for us, given everything that we did, the nature of our capital, the nature of our relationships, to really change the way that business was getting done in the sports ecosystem. And two, from an investment outcome standpoint, it's almost completely uncorrelated to anything else that you can own in your portfolio. So when we talk to our investors about a broad portfolio of sports exposure, and we show them what it looks like against the S&P, against credit, and so on and so forth, what stands out most is just how unique it is in terms of what it delivers to the investor, in terms of the outcome, the inflation protection, the compounding of value, the store of value. So it's actually a really unique asset class, and I think as more people have a look at it and more institutions participate in it, it'll become, you know, much more developed. And
Mike, I'm just going to leave it here because I think this is the only reason everybody's here. I'm saying in jest. The question everybody wants to know: how are the Baltimore Orioles going to be doing this year?
They're looking really good. Looking really good.
Tough season last season, though.
It was a tough season, which is, you know, part of maybe to bring it back to the markets. You don't know, returns aren't always positive, but you hope over a long period of time they are. And so we had a drawdown last year, but we're actually really optimistic about the season ahead.
A perfect way to put it. Mike, thank you so
Thanks,
much for
Danny.
joining me this morning. Everyone, please join me in thanking Michael Arougheti.
Please Please welcome to the stage Paul Schroeder, Director of Factor and QQQ Equity Product Strategy at Invesco, for a conversation with Bloomberg's Eric Balchunas.
All right. Thank you very much for coming to the event here. We're about to talk about an ETF. I'm an ETF analyst. I'm a true ETF nerd. Every ETF has really interesting stories and facts. I think we're going to learn something here today. That was my goal. So we have 10 minutes to talk about arguably one of the, I call it a stud ETF, the Qs. First question, anybody here own the Qs? Okay, a couple people. Anybody here compete against the Qs? Yeah, okay, a little more. Yeah, no, it's tough. It's one of the best performing ETFs since it came out in 1999. It's up 537% in the past 10 years. It's very difficult to beat. Only a couple active managers have managed to beat it. And this is part of the challenge for our industry is how to beat some of these indexes. So I thought, let's go into what exactly is this thing? Our team sometimes calls the Qs the eighth wonder of the world because it just keeps delivering these incredible returns. It's like, what is going on here? Generally, it's tracking the US stock market, but it's not really beta. It's not, like the S&P, and it's not tech either. Only half of it's tech. So, we have some theories. I want to get your theory. This is Mr. QQQ right here himself. How do you define the Qs? What exactly is it?
Yeah, so QQQ, in my mind, what really defines it is its simplistic methodology. As you alluded to, it's not beta. It's not exactly a tech fund. It is a large cap growth fund, though. Right, so it's grabbing the 100 largest non-financial companies listed on the NASDAQ stock exchange. And what we've seen through the years is just using that simple methodology, which is simpler than the S&P 500, simpler than most large cap growth funds out there, is that it's been able to be really the place to go for companies that are highly innovative. Now, you may ask, Eric, how do you really know that they are innovative? Right, because over the past 5 years, that really has become, everyone became innovative, right, the second half of 2020, because they had to survive. But really, at the end of the day, you have to quantify it. And we quantify that through research and development and patent activity. So looking more specifically at research and development, your average QQQ company is spending about $17 to $18 billion on R&D per year. Your average S&P 500 company is spending about 11 to 12 billion. Now, you may also say, well, Paul, there's decent overlap between the two funds now. The Qs is only 100 companies. You're right, there's about 86 different companies from NASDAQ 100 and the Qs that are within the S&P 500. It's interesting, though, if you take those 86 companies out of the S&P 500, that R&D spend drops from about 12 billion down to about 1.7 billion. So you're looking at a multiple of about 11x there. That really is the proof in the pudding of how are these NASDAQ 100 companies innovative.
Yeah, I think it is kind of innovative beta, if you will. Now, why is that? So I've thought deeply about this, as I do about ETFs. As I said, that's my job. And I call it the Steve Jobs effect. If you pull the thread on the Qs, it's like, okay, what is it? It's just companies that listed on NASDAQ. What's the big deal? Well, I think the inception moment here is in 1980 when Steve Jobs, 27 years old, decided to list Apple on NASDAQ. Now, NASDAQ was not the biggest exchange. The obvious place would go to NYSE. And I think he, as he did it in a somewhat of a rebellious move. It was trying to get known as the tech exchange. And I think it attracted a lot of other people who over the years have really become to worship Steve Jobs. If you're a visionary type tech founder, I mean, he's kind of like, one of the real inspirations probably for your career. So I think a lot of people came over. The metaphor I use is when Michael Jordan picked Nike as his shoe brand in 1984. That was also a shocker. Nike was third, not even known as a basketball shoe, and everybody followed him there because he made Nike cool. What do you think of my theory?
Well, being a Chicago guy, I appreciate the Michael Jordan analogy. And I own a closet full of Jordans, so it really was a revolution, right? So, but I think you're 100% right. If you think about QQQ, it really is grabbing just 100 companies that list on the exchange. That through the conversations that I've had with NASDAQ, though, is that's part of their pitch, is that they have a pedigree of having technologically focused companies list on their exchange, right? If you walk through their office off of 43rd in Times Square, you'll see this big pictures of all these large tech giants going public. You have Steve Jobs up there, you have Jeff Bezos, and the many others that have. And if you're a young CEO who thinks that they're going to change the world within their industry, why wouldn't you want to list on the same exchange as those?
Yeah, so if any quants are out here, can we work on the Steve Jobs factor? When we get out of here, I'll meet you later. We'll write a paper on it. Anyway, okay. Speaking of Apple, Apple is one of the Mag 7. Now, the big thing in my industry and research is, should you go away from the Mag 7, right? The Mag 7 make up 33% of the S&P and 40% of the Qs. Some say, this is too concentrated. We did a little digging into this, and the Mag 7, by the way, has acquired 850 companies. I mean, these are gigantic companies. The guy who covers them in Bloomberg Intelligence refers to them as small countries. They are massive. I mean, YouTube and Google is probably the best example. If you spun out YouTube, it'd be like a top 20 stock in the US. So we call them the Mag 70, and that makes us just be a little less worried about the concentration. But we do see this year people going to equal-weighted indexes. RSP is taking in a ton of flows. What's your response when someone comes and says, yeah, I like the stocks, but I don't like the weightings?
Yeah, it's a common question that we get. You know, it's not uncommon for the Qs to have 48, 50% within the top 10 holdings, as you alluded to. Mag 7 makes up over 30% of the S&P 500. It makes up around 40% within QQQ. And with everything that's been going on basically since October, within questions around software, et cetera, we have gotten a lot of those questions. We've seen broadening out within the market. We've seen value taking money. We've seen small size taking money, as you alluded to, RSP taking in nearly $10 billion this year. But I think at the end of the day, it brings up two different things. The first thing would be is that these companies within QQQ are the conglomerates of the 21st century. You mentioned YouTube. It doesn't stop with them. There's Amazon as well. There's Microsoft that has many other subsidiaries underneath a Meta. You know, and it doesn't stop within tech. You have a company like PepsiCo that has a bunch of different brands that are part of the portfolio as well. So you have diversification underneath the hood, underneath that one company's ticker that a lot of people don't realize. The second thing would be is that you have to remember where QQQ typically falls within a portfolio. As much as I would love for it to replace the S&P 500, and I'd be more than happy to have an individual conversation why that should be, realistically, it's used as a bolt-on to your core holding, which is usually the S&P 500. Right? I can understand if I hold SPY, VOO, and the top 10 holdings or Mag 7 are 30 to 40%. But if you're looking at the portion of your portfolio that is supposed to be the growth engine of your portfolio, and then you think about the global economy where you have several major companies, right now it's around 7, right? That could be expanded out to 8 or 9 if you think about it, that have been the driver of fundamental growth over the past 10 years. Why wouldn't you want to market cap weight that portfolio? You know, we've seen fundamental growth within the QQQ outpace that of the S&P 500. You have revenue growth outpacing along with earnings outpacing. So really it has been the growth engine of the portfolio. And I think you need to keep that in mind when thinking about concentration.
All right, just real quick, we got about a minute and a half. Sticking with the basketball metaphor, if the Mag 7 are the starters, give me some bench players. You know, you look at the Qs, there's 100 stocks. I looked through it last night in preparation. What are some names in there that are exciting to you that people don't really think about?
Yeah, so I think if you think about QQQ, a lot of the companies that get the headlines are tech. It's 50% tech. But we like to take a look underneath the hood at some of these other companies that really have been making an impact within their own fields. Intuitive Surgical, which isn't necessarily a household name, but a very large, well-known company within healthcare. You also have a name that moved in more recently that a lot of people don't realize is in there is Walmart, right, from its recent change of venues, right? So that's not exactly on the bench within there. It's a top 10 holding. But you get a lot of different exposures within there. They're outside of the Mag 7, outside of tech, that really have an impact on the portfolio.
Yeah, I mean, if Walmart's on your bench, that's like dream team status right there, I think. So anyway, we're out of time. Thank you very much for your attention, and thank you very much for talking about the Qs.
Thanks, Eric.
All right.
Please welcome to the stage Kelly Granat, Co-Chief Investment Officer and Managing Director at Lone Pine Capital, and Divya Netimi, Founder and Chief Investment Officer at Avila Global, for a conversation with Bloomberg's Hema Parmar.
Hi, everyone. Thank you for being here. And I'm thrilled to be here to moderate this stellar panel with our excellent CIOs of impressive hedge funds. So we have Kelly and we have Divya. We're going to jump right into it. This has been a pretty fascinating and volatile week when you look at the news that's flown out, when you look at how markets are trending. You both also trade public stocks and do private investments and have themes around AI. So we're going to talk a little bit about the AI space. But first, how have you navigated this week? When you look at your portfolio, what are you doing? How are you assessing the kind of risks that we're seeing right now?
Sure. So I'm happy to start. I would say in moments like this, we tend to debate a lot and do very little. Typically, unless we feel something very big on the margin is changing, which would then change how we're thinking about the backdrop and how we want to underwrite against what we are under, the economic backdrop and the risk backdrop. And so, it's really a time to zoom out, reassess, be much more tactical, I would say, in terms of how we're thinking about things, readdress downside scenarios and securities that we own to make sure that we're comfortable with sort of the new set of facts that we're learning and be willing to change our minds. So it's a time to be, I would say, bringing in duration in terms of let's be thoughtful about the short term, mindful of where we're going to get prices and things that get very dislocated in environments like this to take advantage of.
Volatility is inevitable in markets. We're always going to see volatility. And it's a question of, hopefully, at the end of the day, taking advantage of it. But in the meantime, we run scenarios whenever we see macro or geopolitical situations that could create a different scenario for our stocks. We're actually very bottoms up. We run a couple different scenarios, and when that risk reward between the different scenarios looks asymmetric, that's when we'll step in. And volatility is inevitable, but I actually think that's what creates some of the best opportunities over time, and it creates some of the most interesting entry points for us.
So when you look at those entry points, is this a week where maybe you're adding to positions or are you pulling back?
It's actually very stock specific right now. If you look at the markets year to date, the index level hasn't actually moved very much, but underneath it all, stocks have had very big moves. So it just depends on the specific sector in terms of whether we're adding short exposure, whether we're adding long exposure, or whether we're actually taking profits. There's plenty of stocks that are up quite a bit for the year too.
And Kelly, we've seen this kind of volatility in spurts recently. Yep. So does this feel like a new trading environment? And then how do you think about that when you plan your portfolio for the rest of this year?
Well, the flavor changes. I think, volatility is right there. It's pervasive in the market. This is more geopolitically oriented, obviously, and the implications, given the region that we're talking about around oil prices, inflation, those are big topics in the market broadly and impact interest rate policy, certainly in this country. And so there's swirling effects, and it permeates the conversation, I think, differently. And that's the nature of each of these, is they're all a little bit different. For us, I would say, just to the earlier question, we've probably done fewer trades in the last 48 hours, actually, than more. And so we've done very little in terms of adding to longs or covering shorts, and we're just trying to reassess the risk case.
Mm-hmm. You both look at AI. Mm-hmm. And as you look through the rest of this year, can you point out, Divya, we can start with you, one key conviction, bet, or theme that you're really looking at, as specifically as you can speak about it?
Absolutely. We think there's been a monumental shift in AI adoption in just the past 2 to 3 months. We've seen from the latest generation of models a pretty big inflection in agentic coding. In fact, one of the big AI research labs added, they released this publicly, they added 5 times the amount of revenue in January than they did in an average month in Q4. So we think this just has a lot of impact on enterprise adoption in 2026. So we see that across a variety of sectors. For a while, AI was just a bit of a tech story, and now we're going to see it impacting enterprises across different sectors. We're pretty excited about it. I think in the next couple quarters, we're going to see companies come onto earnings calls and talk about real, tangible financial impact. That doesn't mean there isn't opportunity in the tech space as well. In fact, within the tech space, what we're looking for are subsectors that can still grow, maybe even an order of magnitude from where they are today. One example is the data center optical networking space, which we think grows at a much structurally higher pace than just GPU growth. And some of those stocks could grow earnings 10 to 20x in terms of the earnings power in the next couple of years relative to what they earned in 2025.
I would agree. I mean, we've been very focused on the infrastructure part of AI with the view that the lead pole position of who's got the best LLM and is delivering the highest capability is probably going to change multiple times as we figure out as sort of this market consolidates around a few winners over time. And we've been more interested in owning the build-out part of that because that feels like the certainty around this, is that it's all going to get built. The data center build-out is going to happen. And we've been focused on mapping the pockets of constraint as that happens, and where there are resources that are, or inputs to that build out that are in moments of supply constraint where we feel like there are healthy duopoly, triopoly type industry structures, healthy margin structures where there's not the ability to bring on tremendous capacity quickly to change the economic profile for that subsector. So to your specific question, one of the areas that we remain very excited about are the IPPs, the independent power producers, in a world that is increasingly questioning the durability of the AI spend and what the return's going to be. These are physical assets that are in the ground that own the interconnect, and that is what you need to turn basically power on to realize a lot of the inference opportunity and a lot of the scaling laws that we're seeing in terms of what the models can deliver. You need the hookup to the power grid to turn those megawatts into dollars ultimately. And so we think these are businesses that are incredibly well positioned and have the opportunity to extend duration at a moment when we can debate whether memory or optical or certain other parts of the build out are moments in time. This is an opportunity to actually extend cash flows by signing long-term contracts that leverage a lot of that market position.
And you also have a theme at Lone Pine, Revenge of the Dinosaurs. Can you tell us what that means?
Sure.
How did that look?
So this is sort of a big picture idea we have that a lot of the capabilities that we're increasingly learning about, on a daily, weekly, monthly basis now will allow a lot of businesses that are not in the tech space to deploy capability to both improve their unit economics, to probably change their cost structure and the shape of that cost structure over time, lean into a lot of revenue opportunities around doing things smarter, more personalized, more customized to their customer base, in a way that probably changes industry structure. And there are a lot of companies who are old world companies that, simple things like routing densities for logistics companies or customer personalization in a way that allows you to know just your customer that much closer and that much more intimately to service them in ways that are just harder with off-the-shelf solutions in the world, just means that there's a lot of businesses that we think that are highly motivated businesses that can really capitalize on a lot of these technologies.
Can you give us some sorts of examples as to the dinosaur resurgence, if I'm explaining that correctly?
Yeah, I mean, dinosaurs is maybe a bit of an insulting term now that I'm thinking about it on stage in front of a bunch of people. But these are very high quality companies that have the opportunity to use, I think, this moment in the world to take a look at their cost structure and take a look at how they allocate resources and how they invest in technology and think about it differently, right? Because there's things that are on wish lists for companies in terms of capability that are just either too expensive or require a certain scale to make sense for them in terms of allocating investment. And when you have coding costs going to kind of zero over time, and you don't need to rely on off-the-shelf solutions in the same way that you have that can be cost prohibitive, you can actually build software to address business need that is specific to you. And the companies we think that are thinking about that in the most thoughtful ways are going to be able to leverage this technology differently and to play offense around it.
And do those span software to infra to everything?
Totally. There are distribution businesses. There's it's a lot of things in the services part of the economy that are super interesting around this. And a lot of them are physical asset businesses as well. So it just depends.
We've talked about the opportunity ahead within AI, but what are you most concerned about? Where are we going to see, it could be a pullback, concerns, or where you might be either looking at more skeptically or avoiding? Divya?
It's interesting. A lot of people are worried about a pullback or hiccups. And of course, when you're early in a technological transformation, you're going to have that. But one of the other risks that isn't talked about as much is what happens if everything moves really quickly, and what are the ripple effects of that? In fact, with what we've seen in just the last 2 to 3 months of agentic coding, I wonder if 2026 will be a year where the rest of the ecosystem around some of these AI transformations isn't going to be able to keep up. Will all parts of the supply chain be able to keep up? Will shifts in the labor market that need to happen be able to happen as quickly as they would need to be? Will regulatory frameworks be put in place in time? So it's interesting when you're moving at lightning speed and a trend is growing exponentially, sometimes the ripple effects or hiccups come from other parts of the ecosystem that just can't keep up in the near term.
Yeah, I would agree. I mean, I think this is very real when I think about the big technology shifts over the last, my investing career. This is very, very real. The question is just time and distance, really, right, in terms of how does this all get absorbed. The market, I think, myopically focuses on specific questions and moments in time. Right now, it's about the return on all this CapEx, and the numbers are eye-popping, right? I mean, I think if we were sitting here 2 years ago and you said, we're going to be talking about $1 trillion of CapEx across a handful of companies, I think both of us would have said, you're crazy, that's never going to happen. But here we are, and the reason it's interesting now is because for a lot of these companies who are spending that capital, the threat is existential. If they don't win or stake out their place in this evolving ecosystem, there's risk to their core business in a very fundamental way, which is hard to imagine for companies of this scale. So I think right now, I think that's sort of the overhang question on the market is a bubble, right? We get the B word, which makes its way into this conversation very quickly. And I think there will be a bubble at some point. It's hard to identify where exactly it's going to manifest, but it's something that I think we're all tracking really closely, and it goes back to sort of the supply constraint conversation we had before about where there's just tremendous shortage in components that are needed to build out, this data center build, and what happens? What's the capacity response? What's the investment response? Are people rational, right, in terms of staking out their claims? So it's an interesting time for sure.
So we're not in a bubble right now, but we could be. Do you have a sense?
From everything that we know, I don't think we're in a bubble right now in terms of the spend seems very justified. And, when you think about return on invested capital for the big companies and the direction it's heading, until very recently, the big companies that are funding the lion's share of this CapEx were using their free cash flow from their existing businesses to fund. Now that's changing, right? Because that is no longer sufficient to fund the toll of what the CapEx requirements look like. But our estimation today is that it's not a bubble because we're very much believers in the technology and the capabilities it will bring. But for sure, there will be an overbuild in certain parts of this ecosystem over time, and our job is to track that.
I agree.
Does this environment allow for more shorting as we look at long, short equity funds?
It's an interesting question. I mean, we've had this conversation. The market has been much more bucket-oriented, I would say, meaning there's, it's been very holistic in painting the paintbrush of software is a loser, infrastructure is a winner. The Mag 7 went from being a winner to now they're a loser, and it can change really dynamically, and so that makes it harder for shorting in the short term, I would say, because you want more dispersion within sectors to say there are going to be inevitably and invariably winners and losers, right? And we want to do our fundamental research to inform that view and the expression of that view. Right now, it's a little bit more top-down in terms of what the market is rushing to conclusions, I would say, very quickly. And we've seen software, internet platforms, payments companies, all in the last, really, since the start of this year, just get eviscerated with regard to valuation. And really nothing in terms of their reporting has meaningfully changed. It's just that the market's increasingly concerned about what this all means for their businesses and the moats that define their business. And so that's a little bit tricky, I would say, in the short term in terms of making holistic bets.
Yeah, I think it's an incredible environment for dispersion, but the way you're seeing dispersion, like Kelly said, is between subsectors. And right. I think if we're sitting here a year or two from now, what's going to happen is that within each subsector, you're going to see a lot more dispersion. The way AI is going to play out in the economy is that there's going to be winners and losers within every subsector. The company that's forward-thinking, adopting AI, creating a real strategy today, they will probably find a way to leverage AI to create a competitive moat or a competitive differentiation or advantage over other people in their sectors. And if they can do that, they will win. Regardless of whether they're in a tech sector or non-tech sector, they're labeled an AI winner or loser right now. So I think it's actually an incredible environment for dispersion and stock picking. And, and I think that's how it's going to evolve in the coming year or two.
So hedge funds also use AI internally. We've seen funds have their own GPTs. We've seen funds use AI to help absorb large swaths of data. But in the next 3 years, 5 years, we're talking about how the pace of change is so quick right now. Divya, how do you see hedge funds using AI to make investment decisions in a 3 or 5 year horizon?
I think the productivity increase is not going to be marginal. I think it's going to be an order of magnitude. It's going to be significant. We're working on it internally, and we're really excited about it. I think that it's not just that people will be a little bit more efficient at what they do. I think there's going to be entirely new workflows that come of this. I could see things like developing an agent per stock that tracks that monitors all the data around a stock, relays back to you what is signal versus noise. I could see a world where an analyst who previously covered 20 stocks could cover 200 because they are maybe managing a fleet of agents that looks at all these stocks and tracks them. I could see a world where we're able to tackle a far greater number of top-of-funnel ideas and do a bit of work on them and more accurately pick what the best 15 to 20 best long ideas in a given year are. So I actually think it's going to reshape how we do things in the long term.
I totally agree, and we're working on a lot of the same things. It's interesting. I think it will elevate judgment in a pretty meaningful way because it's going to commoditize the base layer of what we do, which is obviously super important because it's the building block of how we analyze companies and industries. And what I mean by that is obviously all the financial building blocks of businesses and unit economics and understanding all the tracking around different metrics that are important inputs of how we think about a company or a sector. But what it will do, I think, so the coverage point is exactly right. You'll be able to, the breadth of what you can look at will be much, much broader, which is fantastic. And also, I think the standardization of a lot of information and tools within our organizations will be super, super helpful for collaboration, right? One of the things we struggle with is it's very easy to get siloed as an analyst, and these are the sectors I look at, these are the tools I rely on, these are the models I've built. And for us, we are spending more and more time as a research team collaborating around ideas with multiple people looking at sectors or trying to solve key questions or things in the market. And so the ability to have standard tools that we're all using to track lots of different things, to inform how the models are trained, will be super helpful, I think, in people being able to pick up someone else's work and say, I totally get this because it's in the same vocabulary that I do it myself.
I see. Is there a universe where the bots make investment choices, discover new opportunities?
I don't want to put myself out of a job on stage.
I see a world where there's lots of bots running around looking at stocks. I do think that there's an art and a science to investing, and there are parts of the quote-unquote science that these agents or bots can do and do it more efficiently than humans can. But then there's also reading a management team the right way, knowing what questions to ask when, how you put the mosaic together of all of your quantitative and qualitative data points, the investment judgment and the pattern recognition you've gained from decades of experience on when matters more in a mosaic. And I think that's all harder to replace.
Yeah, I totally agree with that. I think, so much of, we say to our team all the time, go see companies at their headquarters, right? Because you get a sense of how a company operates. I love to get there early for a meeting when I go visit a company and sit in the lobby for a while and just observe who's coming in, what time are they coming in, what's the mindset of people who are walking in the door? Are they happy? Are they excited to be coming to work? Are they chatting on their way to the elevator, right? Is it a collegial environment? Then we go upstairs and we sit with the C-suite. Are they in some ivory tower, or are they sitting amongst their team? When you sit in a meeting with them, when you've got a whole management team in front of you, do you have the CEO talking over the other executives in the room? It says a lot about the culture and how decisions are made within a company. All this stuff, to Divya's point, is super important in terms of informing who is running the business, right? How are decisions being made? What is the culture of a company, right? And I think it's really hard for a machine to do that equally well. And the last thing I'll say, just similar to what Divya was saying, is pattern recognition is backward looking, right? And a lot of things, we invest behind change. And so the patterns that informed how we invested over the last 5 or 10 years won't be the same, right? History rhymes, it doesn't repeat. And so part of the judgment piece of this is understanding what the patterns look like historically, and then having the open-mindedness and the inputs that change also in terms of what matters, knowing what matters, what are the key questions that might be different than the questions that mattered 5 years ago, to marry those two things together, which is where the judgment comes in, right? There's the patterns that a machine could help you assess and track, and then there's sort of the human element of who are the individuals running these businesses, how are they constructing the cultures and organizations that they're running.
And we saw that with the pandemic, right? With the quant funds really struggling with this situation that has never really happened before.
Right.
But when we look also at hedge fund hiring, what are the ripple effects with having more bots, having more AI involved in the investment processes? How does that impact the way a fund will hire? Will they hire less or different types, or especially for the younger generation?
Sure.
Sure. I actually think it depends what kind of fund you are and what your goal is. I suspect that the shape of the team actually changes more so than the size. I think the productivity increase per person can be leveraged to drive higher investment returns, hopefully. And then what each analyst or PM is doing could just be different. It could be managing workflows in a very different way, rather than a situation where I just think you massively change the workforce over time.
I agree. I don't think it results necessarily in fewer people. I think the skills that we look for will probably evolve a bit. We have always really valued collaboration and team players because our culture is the opposite of a siloed culture, and we do a lot of work across different ideas with multiple people. That will be even more important, I think, in an AI-driven world where the tools are that are driving the analysis are from that nature. I would say also people who have more of just the curiosity is always the thing people ask me all the time. What do you look for when you hire somebody? Someone who's incredibly intellectually curious. I think that curiosity is going to need to also entail some component of AI, right? How do I evolve my process, right? People who are humble enough and self-aware enough to recognize that things are changing really, really quickly, and what worked yesterday won't work tomorrow. So for us, I would say people who are humble, curious, collaborative on sort of the human attributes, and then I would say people who were really good jugglers, because I think things are going to continue to evolve very, very quickly, and past paradigms won't be relevant in the future in the same way.
I want to talk a little bit about the private side of things. We've sort of touched on it with AI, but when you look at private equity exposure or late-stage growth, venture capital exposure, how do you see the secondary market playing out? How do you look at whether to add to some of these positions, which sometimes it's hard to get into, but how do you think about that exposure and balancing your privates with your publics? Divya?
We see a big synergy between doing work on privates and investing privates as well as publics. In fact, we've never seen companies stay private at this scale and growing at this rate. So assembling a mosaic of information from everything you're seeing in the private world and what you're seeing in the public world is actually incredibly helpful on both fronts. And it's interesting. We did an analysis where we realized that the leading AI research labs may actually add more in revenue dollars in 2026 than the entire kind of public software revenue dollars added in 26. And it depends on what your growth rate assumptions are. But we're in a world where it's incredibly impactful. So I actually have never seen synergies this great between looking at both.
I would agree. The evolution of the capital markets is such that many of these businesses don't need to come public at the same point in their life cycle as they have historically. That's changing a little bit now with the LLMs because of the capital intensity of the businesses. But I would say we are very focused on the later stage of the private market where there are public-like companies where we can do public-like research in terms of looking at unit economics and what the historical execution has been and have a real file in terms of how the business has evolved and grown. So we're super interested in the private market in terms of the learning and the synergies, as well as building relationships with the private companies such that when they come public, we already have a relationship. We already have done a lot of work on the businesses. They know us, and we're well positioned to be their partners in the public markets.
And Lone Pine has traditionally capped your privates at, I think, 15%
right.
or something. Is there a world where you increase that? to allow for more exposure?
I don't envision that. I mean, we are really much more focused on public markets. The bar to do privates is extremely high, and we're very interested in that market and have a lot of relationships in that market and spend a lot of time in that market. But we think of ourselves as public markets investors first.
As you look through the rest of this year, what is the biggest risk that weighs on you?
It's a good one.
I think we spent a lot of time talking about AI today. I think it's one of the most complex and nuanced themes I've ever come across in my career. This isn't desktop going to mobile or on-prem software going to the cloud. And as a result, there's a lot of cross currents within that theme itself. So there are areas that are completely bottlenecked, and so they're going to be over-earning, and you have to really think about that and think about when you might see normalized earnings. There are going to be other areas that can still grow an order of magnitude, like we discussed earlier, and you need to separate that out from what the bottlenecks are. And there are very technical parts of this infrastructure stack, that are easier for specialists to get into than generalists, and you have to be incredibly thoughtful. So I actually think it's a time where you want to dig into fundamentals, do really, really deep work, and that'll be kind of what the best thing you can do when it comes to risk. And I think, going back to what we said earlier, one of the biggest risks, in my opinion, is just the unknowable ripple effects from such a complex theme.
I think balance has probably never been more important. I think it's very easy, per the earlier conversation, to get very caught up and draw conclusions very quickly about this subsector is in trouble, they're winners, they're losers. AI is the whole market. There's a lot of amazing businesses in the world that are sort of away from this conversation that probably benefit from some of the capabilities, but in the near term are just continuing to compound intrinsic value, and we own a lot of those businesses. And so I think, to the balance point, it's around not extrapolating what we know today into the future indefinitely, because, as we said, things are super dynamic and changing really, really quickly, and having a balance, in terms of how we think about what's happening in the world geopolitically, that things don't, just keeping ourselves honest around a balanced portfolio, a balanced perspective, and not getting caught up and swayed by these market narratives, which seem to be so definitive for very short moments of time and then abate quickly, and just kind of riding it out. And we rely back to what Divya said. We're very similar in our orientations toward just fundamentals.
Thank you, ladies. This was a great conversation. We could keep going, but we are out of time.
All right.
But thank you very much, Kelly and Divya.
Uncertainty is top of mind for businesses large and small.
Most officials see additional interest rate cuts as likely appropriate if inflation declines over time.
I think we all believe very strongly that the U.S. economy is best served by having an independent Federal Reserve.
Neel Kashkari, President and CEO at the Federal Reserve Bank of Minneapolis, for conversation with Bloomberg's Michael McKee.
Well, thank you all very much. I think you know who Neel Kashkari is. He obviously is a well-known central banker, but I did want to point out that you started your career as an aerospace engineer.
I did.
And maybe that's why you got the superhero entrance stuff there. Then you went into finance, worked at Goldman, worked at PIMCO, and ended up in this lousy job. So I was checking my phone just a minute ago, and we always have to do that with Fed officials now because there's always a tweet, something that's going to come up. Neel and I talked about what we were going to talk about on Friday, and since then there's been a little news. The president's war has obviously disrupted oil prices, and they're way up over the last couple of days. That means gasoline prices go up, so that means inflation goes up. But the Fed has some experience dealing with this, right?
So I think the question is, Obviously, when Russia invaded Ukraine, it sent a commodity shock wave all around the world. And I was on, go back a few years, I was on Team Transitory, which said, hey, I think that this inflation that's coming out of the pandemic won't be that bad and will be short-lived. Obviously, we adjusted that view. That was not the right call, and we adjusted, we raised rates aggressively, in part because of that commodity shock wave. That was one of the contributing factors for why inflation got so high. But now if you fast forward a few years, when Hamas attacked Israel, I was ready for a commodity shock wave that didn't come. And so now the question I think that we are wrestling with and markets are wrestling with is, how long is this going to last? How bad is it going to get? Is it going to look more like Russia, Ukraine, or is it going to look more like Hamas attacking Israel? And that's going to have effects on monetary policy. I don't think anybody thinks when Russia invaded Ukraine and the inflation that resulted that the Fed should have just ignored that. I mean, that would have been the true transitory call. It's a one-time effect. Just look through it. I think right now it's just too soon to know what imprint this has on inflation and for how long.
Well, there's a follow-on question to that in that we've seen a sort of hockey stick action in gasoline prices since gasoline futures went up and oil prices went up over the last 24 hours. It's also used oil in many other manufactured products, in pharmaceuticals, in plastics, etc. How long do we need to see elevated prices before this becomes not just a headline spike, but it gets into core inflation?
Yeah, I mean, that's something we think about all the time. We obviously, you know, Mike, we focus on core. Our target is headline inflation, but we focus on core because core is a better indicator of where headline is going. But even when you strip out food and energy, though they do eventually affect core, because just as you said, energy goes into producing core goods and services as well. So I think that process takes a while. For me, though, the bigger issue is just if headline inflation is going to be elevated for an extended period of time, coming off of 5 years of elevated inflation, boy, that's a scenario that we need to pay a close attention to, and we have to pay attention to what happens to long-run inflation expectations as well. And so there's a lot to pay attention to right now. Coming into this moment, I was feeling pretty good. Inflation is still too high, but I feel like it's been slowly heading in the right direction. The labor market is pretty good, a little bit getting softer, but generally speaking, we're around the bands of our dual mandate. And so I felt like policy was in a pretty good place, and we have the luxury of just letting it gradually glide back to neutral. Now we need to see with this new shock, potentially a new shock hitting the global economy, how long is the effect and how big is the effect? Well, as
Rosanna Dana used to say, it's always something. And years ago, before we started the war, we were worried about tariffs. Remember tariffs. The consensus of the Open Market Committee seems to be, in listening to people speaking, that we're kind of in peak tariffs now. And you've basically said the same thing. Inflation should begin to come down in the second half of the year. But since the Supreme Court ruling, has that changed in your view in terms of we're not going to know what tariffs are for a while now, and we're not going to know when they're going to put them on or how they're going to affect the economy, so you can't really have confidence that inflation's going to come down?
Well, I think there's no question that the Supreme Court ruling and now the uncertainty about what is the new tariff regime, which authorities are they going to use, how close can they get back to replicating what they had originally imposed, that's introduced uncertainty, and uncertainty is a drag on the economy broadly. I haven't seen any evidence that the new tariff regime, whatever it is going to lead to a new round of elevated inflation. It seems like, based on their commentary from the administration, they mostly want to try to recreate what they had before. And the question is, how close can they come to that? So I would expect that inflation, just on that one factor, is likely going to be on the same trajectory or maybe a somewhat lower trajectory if they're not able to fully replicate the tariffs that they had before. I haven't seen a lot of evidence that tariffs are going to go much higher from here, but we need to see.
Well, does this push out the time frame for you to be able to have confidence that we're not seeing a tariff impact?
Just on the tariff effect, setting aside geopolitics in Iran, just in the tariff effects, it isn't obvious to me that it's going to delay the expected deceleration of inflation, because I don't see a lot of scenarios where they're going to substantially increase tariffs from here.
So where do you put yourself now? Obviously, you have to put a new dot plot together for the next meeting on March 18th. what do you think? Do you think, first of all, there's going to be any move in March? I would assume you would say no. But after that, when do you think it's more likely that you might consider it as a live issue?
Well, in December, if you look at my December SEP, I had preferred us not cutting in December, but the committee did. If you just do the math, I effectively had 1 dot now for 2026. I basically had 2 and 2, and because they did 3, then I brought 1 dot forward. So that leaves me with 1 dot coming into recent events, so 1 expected cut later on this year. Now with the geopolitical events that we talked about, I just need to see. We need to get a lot more data in. The inflation data before Iran, I think, has suggested that inflation is running somewhere between 2.5% and 3%. I think housing inflation is trending down. I've got a lot of confidence in that. Core goods inflation has been trending up because of tariffs. Services inflation, I think, is slowly trending down, tied to the labor market. And the labor market is in a decent place, but showing some signs of softness. And so that's what gave me confidence that, hey, 1 cut later this year might make sense.
Now, the neutral rate, I don't know. Well, tell us where you think we are compared to neutral, because the question I have is every SEP says that the Fed will hit its target 2 years from now.
I know.
And the next SEP says 2 years from now. Are you ever going to really hit it?
Well, we have to hit it, and I think my colleagues and I are committed for the credibility of the institution and for anchored inflation expectations that we absolutely have to hit it. But where the neutral rate is has been a big question mark. Over the last several years, we kept forecasting that the U.S. economy is going to slow down, and then it just powered through. I thought when we raised rates as aggressively as we did that we'd be slamming the brakes on the economy. We weren't. The economy proved to be much more resilient. In the face of tariffs, it created a lot of uncertainty, created a lot of noise, raised goods inflation went up, but the U.S. economy proved more resilient. And so the fact that the U.S. economy has been this resilient, given the stance of our monetary policy, tells me the neutral rate must be higher, at least in the near term. And the thing about the dot plot, which is it's a very imperfect communication device, that long-run dot is meant to represent where is the long-run neutral after all of the shocks in the economy have passed and everything is settled back down to normal. That doesn't necessarily tell us that much about where is neutral today.
We don't know when the shocks will ever stop under
Correct.
this administration. At the last meeting, and you touched on this just a second ago, the focus of the committee's concern seemed to shift away from the labor market back to inflation. Are the risks now balanced?
They feel more balanced. Again, before setting aside the recent geopolitical events, which we need to understand, the inflation and labor market do feel more balanced. I'll give you a quick anecdote. I go out and I travel around my district, which is Minnesota, North and South Dakota, Montana, part of Michigan, and northwestern Wisconsin. North Dakota is always structurally short of workers. So for 10 years I've been going to North Dakota, and the number one issue I hear from businesses large and small is we can't find enough workers. I was in North Dakota a couple weeks ago, a roundtable of small businesses, and roughly half the businesses said we're fully staffed. That is the first time in 10 years I've heard that from businesses in North Dakota. Part of the story of why there's been no job creation is because there's been very little immigration into this country. But anecdotes like the North Dakota anecdote suggest to me there's also not a lot of underlying organic demand for labor right now. So I do see signs, yes, 4.3% unemployment rate is still a good unemployment rate, but I do see evidence that the labor market is not demanding a lot of more workers right now. So I take that and I try to balance that against the fact that inflation is still too high, but I do believe it's gently trending down.
Now, you said you travel around talking to businesses around the district, of course, and I'm wondering what they're telling you about this low hire, low fire environment. Is it because they can't find workers that they're not hiring, or is it because of all the uncertainty that they're not hiring? Are they finding that they can get the job done with the staff that they have, and therefore we have a new dynamic?
I think it's the latter too. I think there's remains a lot of domestic uncertainty and global uncertainty, the topics you all are well aware of, and they are finding they can get by with what they have. And every business, large business that I talk to, I ask them specifically when I talk to the CEO or one of the senior leaders, are you using AI for real? Not just some little pilot, are you actually using it? And virtually every business says yes. Even businesses that 2 years ago said that they were skeptical, that consultants were pitching them AI and they aren't even sure how they could use it. They give me real specific examples. Now, it's not transforming their whole business, but there are pockets of their business where they've been able to put it to work and do things that they couldn't do before, or do things much more efficiently. And I do think that that is affecting their decisions on, okay, how many people do we want to hire given we are early in this adoption phase?
Staying with AI, because you brought it up, there's an argument that's being made by some people that you would be able to have lower interest rates because AI will increase productivity. There's also an argument that AI will lead to a higher neutral rate because of investment and or demand rising. Where do you come down?
I mean, I think if you have a massive new, AI is not a low capital technology. This is massively capital intensive, with hundreds of billions of dollars or maybe trillions of dollars going to build data centers and compute, things you all understand. If the economy, how does that happen? All right, the economy reallocates capital to its most productive use through higher rates. And that means apartment buildings that would have been built absent AI, that capital is now going to shift over and build data centers because mortgage rates are going to be higher than they otherwise would have been. That's how capital gets reallocated in the market economy. And so my first long term, could it have an effect on the neutral rate and bring things down? It's possible. In the near term, do I think it's probably pushing up the neutral rate? Yes, I think so, likely. And you know, people make comparisons to the 90s and Greenspan famously saying, hey, there's a productivity boom. It wasn't a debate about cutting rates. It was a debate about whether they should be raising rates, and Greenspan used the productivity insight to say, let's just hold them where they are. By the way, that was about a 5% federal funds rate. And so when people look to the 90s, I think that there are lessons to be learned from the 90s, but I don't look at that and say, oh, that means we should be cutting rates right now when the policy rate is well below where it was in the 90s.
What are the CEOs telling you about pricing? Are they sitting on the need to raise prices? Are they going to be raising prices because of tariffs? Where are they?
The most common comment that I've heard in recent months is you would expect to see some repricing at the start of the year. That they were reluctant to pass on, they passed on some cost to their customers last year. They wanted to try to adjust their supply chains or adjust their product mix to avoid having to pass that pain on. But the longer it goes, eventually they will have to pass it on, and that the start of the year would be a natural inflection point. So I think we are starting to see some evidence of continued pass-through in this early inflation data. But I'm not hearing a lot of anecdotes that they see major inflation waves yet to come. It's more that things are slowly adjusting to the effect of tariffs from last year.
So this is still a look-through-it situation.
It's a pay attention to it situation. I mean, yes, we're trying to get a sense of where we think inflation is headed, but we can't be completely dismissive of the fact that consumers are feeling the prices. I mean, you look at the goods inflation, core goods inflation is real. It should be negative in a normal American economy in recent years. It was negative briefly, and then it has climbed linearly since then. And so that's real, and that's having an effect on the economy.
What's your forecast for inflation this year then? The progression, I assume you end the year lower than we are now.
Yeah, somewhat lower than we are now. And I'm more focused on the trajectory than I am, are we going to print 2.5? Are we going to print 2.2? But generally lowering. Again, I go through the fundamental components, the big components. Housing inflation, I have a lot of confidence, is trending down because we understand the mechanism from new rents and new leases. After a year or two, it translates into the official housing statistics. New rents and new leases have come way down. So we've got a lot of confidence that housing inflation is coming down. That's a big piece of the basket. Then you've got core goods, I talked about, had already returned to slight disinflation, which is normal in the U.S. economy, climbed because of tariffs. That ought to be a short-lived event, unless there's new tariff effects brewing. And then you have core services outside of housing, and that ought to be tied to wages. And if the labor market is slowing, and I think it is, that ought to be coming down. So that's the reason I've got some confidence that inflation is heading in the right direction, but for recent events, which now has introduced a new shock that we need to pay attention to.
Or as I've said, and yet here we are. So how much confidence do you have in the forecasts that you're going to be putting out in March?
I mean, I had a lot of confidence up until a couple of days ago that just like the dynamic that I described of where inflation is heading, I had more confidence. And so now back to where we started. Does this more like Russia? Does this look more like Russia invading Ukraine, or does this end up looking more like Hamas attacking Israel? I don't know yet, and so we need to wait and see.
So let's shift gears a little bit here and talk about the new boss. For you Who fans out there, not the same as the old boss. It might surprise the president, but the Fed chair just can't walk in and lower interest rates on their own. The main power the chair has is persuasion. So how do you think Kevin Warsh will do with that?
I think he'll do well. I mean, he's obviously spent 5 or 6 years as a governor at the Federal Reserve Board, so he knows the institution well. I think he's been focused on and studying these issues for a long time, and I think he will come forward with, he's talked about a wide range of things in between when he was at the board and now. Everything from monetary policy to how we implement monetary policy to how we're organized. I think those are all great topics, and I look forward to hearing what his priorities are and then engaging in the discussion.
He hasn't been exactly complimentary about the Fed in the last couple of years. How's that going to go over? How does that go through the system?
I think it'll be fine. I mean, I think, look, we've made mistakes. We're not perfect. I think we're all doing our very best in a highly uncertain environment. I've said I was on team transitory. I thought that inflation coming out of COVID would be shorter-lived and not that bad. I was wrong about that. And so I think we should be forced to step back and look at what have we done well, what did we miss, why did we miss it, and how do we do better going forward.
Now, assuming he is confirmed and in place on time, how long will it be before people like me are referring to it as the Warsh Fed, in the same way that people ask, when did it become the Trump economy? When do you think people will look at it as him as the centerpiece driving the Fed?
Boy, I haven't thought about that. I mean, that'll be for you. That'll be your call, because you're going to be writing the headlines, or your editors will be writing the headlines on top of your stories. I don't know, but people are going to take his views seriously the moment he shows up, the moment he engages in debate and makes, the chair has a lot of influence. The chair can say, hey, here are the range of options I want the committee to consider. And then we have deliberations around those options. And so I think the day he shows up and starts setting the agenda for the FOMC, in a way, it becomes his Fed.
Well, one of the things he wants to do is have a smaller balance sheet. Now, whether that means you go back to scarce reserves or just a smaller balance sheet, where would you come down on that idea?
I think it's timely to have that debate. When I first got to the Fed 10 years ago, I asked the question, why did the Fed switch from a scarce reserves regime to an ample regime? And one of the explanations I was given is that, well, an ample regime is much simpler. Instead of the New York desk having to trade in and out of markets to keep the federal funds rate in the range, you just set a rate, you dial it in, and you forget it. Sounds great in theory. In reality, we do that. We also have a ceiling facility called the discount window. We have a separate ceiling facility called the supplemental facility. We also have a floor facility called the ONRRP. Once in a while, we have to make technical adjustments on the rates to keep things in the range. And then once in a while, the New York desk still has to intervene and inject reserves into the market. So this very simple regime that we've created is not nearly as simple as it was originally explained. And so for us to step back and look at that and say, is this optimal for the U.S. economy? I think that would be a debate that would be well worth having.
He also thinks that y'all talk too much, and he has suggested he'd like to see fewer, more coordinated speeches and essays. You've been at the kind of forefront of communicating through all kinds of means. So should he clip your wings?
Well, I don't know what you're going to do all day if he does that. Here's the challenge.
Bias.
Yeah, exactly. Here's the challenge. So this is my approach to communicating. When I go out across my district, we get lots of invitations from chambers of commerce and universities and Rotary clubs. I turn down the vast majority of those, but I do want to visit every state of my district at least once a year and just communicate what is it that we're looking at the Fed. Most of the time, I'm not seeking to make news. I'm just explaining, hey, this is what's going on in the economy. This is what we looked at. This is why the committee made the decision that they made at the last meeting. Now, I also live stream these events in the spirit of transparency, so I'm not shedding secrets. And yet, me doing that can lead to some headlines. And now when you have 12 presidents doing that across their districts, it's good for democracy because we're communicating to our constituents, but I can also see how people say, well, it generates a lot of headlines on certain news outlets. And so I don't know how to change that if you want to be transparent to the American public and transparent to the communities that we are charged to represent. That's the part that makes it hard.
As far as we know, Kevin Warsh hasn't been formally nominated yet, and then he has to go through the nomination hearings, and we have one senator at least who says he's going to block everything until the investigation into Jay Powell is finished. In your understanding, what happens if Warsh is not confirmed by the time the chair loses his chairmanship, not his seat on the board?
Well, this happened between Jay Powell's first and second terms, and it happened sometime in the Greenspan era too, where there were delays, not through any big problem, but there was just a delay in the White House acting and the Senate acting. And my understanding is the Board of Governors votes at that moment to then re-extend the current chair to serve as chair pro tem. So it's just an extension, so to speak, of the role at the Board of Governors, and that'll be up for the governors to sort out. But that's the precedent.
Well, the interesting thing is you vote every year who's going to be the chair of the Open Market Committee, and this year you voted Jay Powell to be the chair until next year. But in that past episode, they just voted to have him be the chair until a successor is in place. Was the board trying to send a message?
I'm unaware. I mean, that was every year. I'm used to every year we have a vote on who the chair of the FOMC is going to be for that year, and this just seemed like the routine process that we followed every year. So I'm unaware if there was some implied message intended to be sent.
Would you like to see Jay Powell stay on as a governor?
I think Jay Powell's done a terrific job as a governor and as chair, and I'd love it if he chose to continue because I think he's a great colleague.
We'll finish up with an audience question here. If employment continues to soften and inflation doesn't come down, which is worse for America?
It's hard. You know, this is a pickle. I'll give you a quick example. Conventional economic analysis says that recessions, so high unemployment, are devastating and worse than inflation. But when I actually talk to workers, like I've talked about this publicly before. I've talked to a local head of a labor union in Minnesota, one who represents low-income service workers. And she made the opposite comment. She said for her members, inflation is worse than a recession. And I said, I don't understand that. In a recession, you lose your job. In inflation, you just pay more. She said, because my members are used to recessions. They rely on a brother, a sister, a mom or dad, a friend who still has a job to help them get through it. But inflation affects everybody. So there's nobody in your network you can lean on for help because they're all suffering like you are. That was a profound insight that I was not ready for, and it made me step back and reassess my judgments about these things. So I'm going to give you an I don't know answer. We got to get inflation back down to 2%, and we need to keep the labor market strong.
So all these people can rush out at lunch and trade no move in March?
I'll let you speculate about that.
All right. Neel Kashkari, thank you very much for coming in and joining us today.
Really appreciate it. Thank you.
Losing my microphone. I'm your sort of last guest here in the sense that I get to send you all off to lunch. It is lunchtime. Before you head off, please, these are the brief instructions you need to know so you know where to go. Our staff also is going to be outside to guide you. If you're attending the general networking lunch, you are going to go out this set of doors, make a right, proceed down the stairs. And be sure to check out the Investco QQQ Resource Center while you enjoy your meal down there. If you are registered to attend the Technology Empowering Growth Lunch Breakout, sponsored by Investco QQQ, please exit out the doors and go straight down the hall to Hub 1, near where you walked in today. And if you're registered for the Unlocking IPOs Roundtable Lunch, you will also go straight down the hall to Hub 3, for that. Just outside the hubs for these 2 days, by the way. We invite you to visit the Bloomberg Terminal Lounge, grab a coffee, connect with colleagues, chat with Bloomberg experts. You can look up WIRP and see what the odds are of a rate move. So please be back here at 1:45 p.m. sharp. We'll pick back up with a great afternoon of speakers, including a live podcast taping of The Deal with Alex Waxman of 6th Street. And a reminder, if you haven't done so, scan your QR code to download the event app. You can see the Invest Community schedule. You can see you can schedule meetings with people in attendance and plan the rest of your day. So have a great lunch, and we'll see you all back here in an hour or so.